Hey traders, I'm James, one of the content team leaders here at A1 Trading, and as we start today's stream, I wanted to let you know about one of our show's main sponsors, FX2 Funding. With all the craziness going on in the prop firm space, we're excited to share some of the solutions FX2 Funding has put together for their traders. First, FX2 is rolling out DX Trade, which is a web-based trading platform that provides traders a smooth trading experience. It also looks super cool too, but that's not all. By signing up with FX2, you get access to C-Trade. C-Trade is a trading terminal where you can create custom indicators or download ones from the community. Get access to all of this and more by signing up for FX2. For traders looking to get funded, this week only, FX2 is having a 45% off sale. To get everything FX2 has to offer, use promo code A1Trading15. Again, this huge 45% discount is available this week only. So use promo code A1Trading15 at checkout. Links and promo code can be found in the description below. Now, onto the A1 Trading Show.
All right, good morning, guys. Welcome back to another live stream. Thanks for tuning in. Hope you're doing well. We've got a pretty big stream here today. We've got the producer price index followed by Jerome Powell speaking later on here today. We've got an action-packed show planned for you. And you got markets on the move here ahead of the report. This number is really massive. And by the way, guys, check out the haircut. Got it trimmed up a little bit. It was getting a little long. I was, walking around and dragging my hair on the floor. It was getting to be a little long. That being said, I'm not having the best hair day today. Now that I'm looking at myself here, the crazy thing is when you do this every day, when you live stream, sometimes you don't realize like, oh, hair's not looking the best today until I just like pop in front of 334 people, but it's okay. We push on. I'm married. Who am I trying to impress? My wife likes me. That's all that matters. Anyways, let's talk. Let's talk about what we've got here on the radar today. By the way, so we have the producer price index. I was thinking about using what Ivan uses today. I'm going to give FX Street a shot because I've been recommended several times that Forex Factory actually just stinks. So I've used Forex Factory for years, guys. This might take me a minute to get used to, but we do have on the radar today, we have the producer price index year over year, which is going to be coming in pretty soon, and the month over month number as well. And you can see already with FX Street that we've got several factors here. What's up, Ivan? Ivan, by your recommendation, I think I'm going to give FX Street a shot today just because I want to see that I get all the numbers. And sometimes Forex Factory just doesn't show all of them. So shout out Ivan, shout out FX Street. And yeah, FX Street team. Yes, indeed. Okay, so let's talk a little bit about what this PPI number means. Couple things to note. PPI today, I think, actually has more excitement on it than usual. Usually, this is what we have. Usually, we have CPI first, and then the next day or the next days, we get the producer price index. But today, it's the other way around. We're pulling a little bit of an Uno reverse. We're saying, nope, actually PPI first, then CPI. So I think PPI going first, do not discount how impactful today's PPI number could be. The market is antsy about inflation. The market is very, very curious to see what inflation figures will come out to be. It will be, I'm talking all markets, right? There's several things that will be impacted by this. The stock market, I'm talking about the dollar index, I'm talking about currencies, I'm talking about gold, everything, okay? Very important. Commodities as well. The producer price index will give us an idea of what the wholesale prices are looking like. Are prices going up on the supply side, on the supply chain, or are they normalizing? And the market really wants to see inflation start to cool off. They really, not only that, you have a market here that, in my opinion, let me just paint a picture. If you get hot inflation figures, I'm going to look at this market as way overbought. Okay. But if the number comes in cool, which some people are, or many analysts are forecasting and hoping for, if it's cool, suddenly the market probably could even try to retest the highs and maybe even break out through the highs. Okay. So let me be very clear and let me sun some people in the audience really quick. People are going to have like their opinions. Oh, I should buy this, or should I sell the NASDAQ, or should I buy gold, or should I short the dollar? Listen, guys, none of us have the massive number crunching systems that the economists around the world are using to try and forecast what's going to happen next with inflation. So we don't have a floor full of PhD computer science, geniuses to crunch and tell us what the inflation figure is going to be. Let me tell you right now, uh, high, highly suggest that you do not try and forecast or predict what the CPI or the PPI is going to be. Okay. You guys obviously do not follow Trader Nick's advice. Yeah, that's the thing. You got to be careful because none of us know. Okay. Now, does that mean that you should just pack it up and never trade again? No. What I'm saying is that forecasting, predicting what's going to happen on CPI, PPI, just don't get caught up in that because it's just a dumb game. You're not going to know what's going to happen. The forecasts that are out there are generated by, people with tons of economic prowess, and they still get it wrong. So my point is this. We trade the aftermath. We trade what we see happening in the moment. So if, for example, we get an inflation figure that is very, very hot, that may be a signal, right, in the short term that the S&P, if you already had a bearish bias going into this, perhaps that could lead to a little bit of a sell-off. But if it comes in really cool and you get like a breakout, then maybe you trade the pullback. Again, if you understand the fundamental story, how inflation figures marry up to the full picture, that's where you can trade the aftermath very well. That's what we try and do on these streams. So let me just give you a disclaimer. If you're looking for a caffeine junkie, spike junkie live stream where we're trading the intra spike when the slippage is horrible and your spreads are massive and your broker's just walking away with all your money, this is not the stream for you. In this stream, what we'll be doing is we'll be watching the numbers, both PPI and CPI tomorrow, and we will be reading into them and trying to get a full picture view of what the producer price index is telling us about the inflation story. If inflation comes in hot today, the dollar index very well may look like it's going to actually hold this support level and rally higher. But if you get PPI coming in cool, I think you've lost the last leg of defense. I mean, of course, you could have CPI that comes in opposite, but let me just point this out. The dollar is on thin ice right now. In my view, the dollar has seen several, weak numbers. That's not even my view. That's just what we've seen. It's why, by the way, the Edge Finder's been giving us a bullish reading. I'm in profit on that. My stop is trailed into profit going into this news. That's my update for that. I know a lot of traders are watching gold. I already have longs on gold, but my stop is trailed into profit. So that's just some context on that side. But understand that today, if you get, when we take a look at the economic data for a second, and we look at the dollar. Let's take a look at, just go to our Forex scanner for a moment. You'll see that the euro is getting a bullish read right now. It's because most economic data looks pretty weak for the dollar, right? So my point with saying that is if we go over here, I'm going to actually just do something really quick. We'll go to the top setups page and let's just filter by major currencies for the currency traders out there. Let's add in our neutrals. And what you'll see is that when we get to the economic data section, there's not really a clear decisiveness for the dollar anymore. For a little while there, the dollar looked really strong because, GDP, PMI, retail sales, inflation was hot. We've lost that story a little bit. Well, we haven't lost the inflation story. The question is today, do we lose the inflation story? If you lose the inflation story today, what I mean by that is if inflation comes in cool, the dollar is going to look like, in my opinion, a sell against most currencies. If it holds in there, if it's hotter than expected, okay, then I'm staying neutral on the dollar. So I'm tentatively, potentially bearish on the dollar as we go into this number. I'm not saying I'm shorting the dollar or selling dollar, but if you get inflation cooling along with everything else, the dollar story is no bueno. That's my opinion. So we're watching that. That's the big potential here today. Again, if we go back to all charts here, the top setup right now for me is bullish. I am long gold. I'll show you guys my setup here on gold. My stop loss is trailed below. If today's inflation data is not favorable to gold and we drop, then I'll take a profit. My first entry is here and my second entry is here. So I will take a very small profit. I actually added a second trade inside of the VIP room yesterday afternoon. So I am long on gold going into this. I'll give you my opinion on this, and I could be very wrong. I'm not a fortune teller. So let me just tell you my opinion. I'm long on gold, and my thought process is this. The economic data, if we take a look at like the economy, let's go here. So ECO, economy, right, has been cooling. If you get inflation hot, what you have in this scenario is stagflation, right? Slowing economy, stubborn inflation. Stagflation is a very bullish environment for gold, okay? So that's positive for gold. But check this out. If you get inflation coming in light today, right? Let's say you get inflation, and we're getting close, so let me not mess this up and miss the news. If inflation comes in light today, I also think gold is not necessarily just an outright sell. I could be, again, very wrong about this. That's why I have a stop loss trailed and I'm in profit. So I'm not, I'm not gambling on this event. So let me just be very clear. But if inflation comes in low and the economy is also, we know this is our given, right? We know this already. The economy seems to be starting to materially weaken. Okay, if inflation comes in cool today, the Fed's going to start cutting rates. That's also bullish for gold. So in my opinion, again, huge disclaimers here, I think most scenarios, gold continues to trend higher. And if I'm wrong, I will take it in my stop loss and I'll get a little slack for it in the comment section. But I'm telling you, this is not financial advice. I'm not telling you what you should do. I'm telling you what I have done, and you make your own decision. If you want to go blow it on GameStop, or if you want to go, YOLO into a news trade, that is totally up to you. But I am here doing what I'm doing and sharing my opinions on the market as always. Okay, so let me go ahead and transition here. We got just over 1 minute before we get the numbers. So I'm just going to pull up all of our markets here so that we can watch together. For those of you who are watching indices, we've got the S&P 500. We got the Dow here. You've got the NASDAQ over here. Here's the dollar index. You've got the pound, the euro, gold, and oil. We'll watch this together, and then we'll go through the numbers together. So let me just ask you guys as we get closer. We're about 1 minute out. Do me a big favor. Hit that thumbs up button on the stream if this has been helpful to you in preparing for this producer price index number. Biggest thing you can do just to support my channel, if this has been helpful to you, it's totally free. Just smash the thumbs up button, and I really appreciate it. Okay, so we're about 30 seconds out here from the number. Let's see what we get in terms of the producer price index. I'll have coverage, so don't go anywhere after the spike. The real fun starts after the spike. Everybody thinks it's before or during. The real fun is once you actually get some data to trade based on. So coming in, breaking news coming in just after this. All right. I'm coming in very, very close here, guys. About 8 seconds to go. Let's see what we get for producer price index. All right. And the stock market just dropped hard. Gold dropped as well. Oil. Let's see what we've got. That looks like probably a bit of a little bit of heat in the inflation department. And there it is. The actual came in. The producer price index month over month came in 0.5 compared to 0.3, hotter than expected. The producer price index year over year came in 2.2 as in line with. So this is a hot print. And so there you go. The stock market's down here on that news. Let's see what the damage is in terms of a percentage basis. Yeah, you got about a 0.5% move lower in the NASDAQ. In the S&P 500, you're down 0.36. Again, let me reiterate, I could be very wrong, but this inflation figure coming in hot, I don't actually think is incredibly bearish for gold. So yes, it's dipping, but in my opinion, I think we stay supported and that the gold market continues higher. If I'm dead wrong about that, my stop loss will smack me and say, you were wrong, dummy. But again, there we go. So producer price index is out, hotter than expected inflation. One thing I will add context-wise today is remember that we are in the, hanging on the edge of a cliff here because CPI is tomorrow and so is Jerome Powell. So yes, you're getting a move here. The market is down to start the day, but I would not be surprised if we normalize after this, or if we just kind of hover around this area in anticipation for what arguably is the bigger number, which is the consumer price index coming in tomorrow. So again, the producer price index came in hotter than expected. The market is not going to like that because, again, that could push back the expectations for rate cuts. Not ideal for sensitive areas of the market. And again, you guys heard me say it, but this is my opinion. I'm going to stand by it. I am long gold. I'm staying long gold because I don't necessarily think that what you're seeing here is a bear case for gold. I think inflation staying high is not good for gold if the economy is strong, but the economy seems to be showing signs of slowing down. Not great specifically for stocks, right? If you see the stock market, if you get a hot inflation read plus you get cooling economic data, then you have a story that's not so great. So let me just go check again. We're going to stand by this reading. Very bullish on gold. Overall, I'm staying there. Euro dollar might look good today with that hotter than expected print. Well, actually, I'm sorry. Euro dollar might look a less attractive today with that hotter than expected print, but I still think we wait for CPI on some of the currency pairs. Let's see what else we've got. The Nasdaq's in neutral. U.S. oils at neutral. On the bearish side, we got Bitcoin, Kiwi Swiss, Aussie Swiss, Dollar Swiss, CAD Swiss. So nothing too exciting on the sell side for me. Again, I do have a Bitcoin short. Did that do anything to Bitcoin? Let's go check out. Yeah, Bitcoin. There we go. All right, let's switch over. I have a small short on Bitcoin. I'm sorry, crypto crew. Don't come at me. It's just a trade. But I am short on Bitcoin, so that's come back in a little bit here. This is a little bit of a swing trade here, so you can see even though it's moved a lot, on the hourly chart, on the daily chart, it's got plenty of move one way or the other to go. So again, I think inflation, as I would have kind of anticipated, a hot read on inflation is not great for Bitcoin because again, it's going to cut into the consumer's budget to go gamble on crypto. So. And by the way, I'm not necessarily a crypto hater. I'm just saying that I think that a lot of the crowd that does happen to invest or buy Bitcoin typically is like sub 35-year-old people. So, yeah. Anyways, the S&P 500 again slightly down on the day. The Nasdaq is down on the day 0.32%. Let's take a quick look at some sectors here. I'm going to have to do that for us. Just SMH, so the semiconductors down 0.34%. Let's go to a 4-hour chart so we can see a little bit of price action. The technology sector is down 0.5% on the day. Consumer discretionary, I don't know why it hasn't had any trades on it yet today. Staples, financials. So seeing some volatility on that front. In terms of currencies, you got the euro trying to push higher here on the 4-hour chart, looks supported despite the hot print. Again, euro dollar, I think it's going to come down to the CPI report tomorrow. But GBP, USD, here's dollar yen, just doesn't care what's going on, seems to just want to trend higher anyways. Dollar Swiss, the Australian dollar, the Kiwi dollar. Okay. Let's go back to gold here for a second. So here is my view on gold. Again, I mentioned I added a second trade to my gold campaign here. I went ahead and got back long gold. As soon as the Edge Finder produced this bullish reading, I went over to look at the charts. I waited for the pullback with a score of +10. For me, that's hard to ignore with my system. Edge Finder was saying very bullish. I went long, and currently P&L is looking like this. Let's see. P&L, we are up 32.70, let's call it, on the position. So not bad. I will take it. Stop loss, like I said, is trailed in profit. So if this market tanks, we'll make a small amount of money. And if it keeps running, which I think it could, gold might look really good here. Again, as I mentioned, I'm going to keep coming back to it. Even if the inflation number came in hot, I still think that gold looks good because gold, you're seeing the slowdown in the economy, right? I'll show. Let's go on a trip here. You guys ready? So the Edge Finder. Here's the thing. We can go through a couple points here. GDP came in lighter than expected. Forecasts were 2.5. We got 1.6. Okay, that's GDP. Hold that. Next up, PMIs. Look at this. The manufacturing sector came in lighter than expected. Some slowdown in manufacturing. Okay, that's 2. But what about 3? The services PMI repeated the same function. Okay, services section of the economy came in lighter than expected. For the PMIs, right? This is the Purchasing Managers Index. It's like asking a bunch of executive people who make decisions at manufacturing plants or whatever, right? If you ask them about like, are you going to be hiring? Are you buying durable goods? What are you doing? If they kind of show that they are expecting to slow down a little bit, that's what this is looking at. That's why we keep the PMI data on tap on the Edge Finder for you. Okay, so GDP, PMIs, what else? Well, the jobs market cooling off a little bit. Again, our first significant miss came in on last Friday's jobs number, or May 3rd. We got 175,000 jobs compared to what was forecasted up at, what was it? 238,000 jobs. So what you're seeing here, guys, is you're seeing a story being painted of, okay, the economy seems to be relaxing a little bit. And I'm not necessarily saying entering a recession or anything like that, but you have to start to wonder when the train starts changing directions, right? It's very slow at one point, but it's very hard to call when it's going to stop. So what I mean by that is if the economy is starting to materially slow down, here's unemployment claims ticking higher, right? This is why data matters, guys. This is why we use the Edge Finder on all of the videos. We have to keep an eye on the data. Job openings starting to slow down. Okay, well, what about unemployment rate? Unemployment rate trending higher. Again, if you have this data in front of you, you can start to see what I'm getting at. Wage growth starting to slow a little bit. Okay. So the point here is this. When you look at the economic data as a whole, which is what the top setups algorithm does, is it looks at all of this economic data and it factors in bullish and bearish readings. Sure, inflation being hot might not be the best thing for gold if the economy is strong, because then they're going to raise rates. But if inflation is coming in hot and the economy is struggling, that's a scary environment. And there's a word, you can hear it coming, I bet. What's the word I'm about to say that drives gold higher? Fear. The other one could have been stagflation. Both of those answers would be acceptable, right? Cooling economic data, inflation that doesn't want to go away, and suddenly you probably don't want to buy companies, right? If the market's looking really bad for, growth going forward and inflation's still stubborn, that's not the best for companies, but it's very good. In fact, maybe the ideal scenario for gold, right? There's only one other scenario in which case I think that, maybe gold looks better. And that would be where you have an economy really slowing down and a massive QE campaign trying to save the world, right? Like 2009, remember when gold went like up parabolic because the Fed turned on the printer, but everybody was terrified about the economy. That was gold's like super cycle. Well, we could start to see something big for gold too. And again, that's why I am bullish. That's why I have, money on the table. And there we go. We're back up in the positive today. Stocks are flat. So we've given back, that big downside move has come back a little bit into play. But again, I remain very much convicted on my gold play. I have my risk managed. My stop is in profit. If this thing rolls over and dies, I will still make money. So I'm in a good spot with the gold setup. We shared this inside of the Discord. By the way, if you guys want to join the Discord channel, if you're liking what you're seeing, if this is helpful to you in any way, please take a second to join our Discord channel. It is free to join for our daily analysis. And if you sign up for the VIP room, you can get the trades being taken by myself and by my colleagues on an intraday basis. So if you'd like to see the trades we're taking, make sure, number one, join the free Discord. And number two, if you're with us live and you would just like to jump in on the trade action, if you'd like to get access to the signals that are being shared, again, let me also be very clear. When you pay for a service with us, a lot of times people sell signal services and they're not putting their real money on the line, or they're never showing you a live account. When you join our signals group, please understand These are live accounts. Again, I'm on a US regulated brokerage. When I take trades, I punch out the orders to the group inside of Discord so you can see what I'm doing with my personal hard-earned money, okay? So I say that as a confidence builder. If you're thinking about actually joining a service, you should never again join a service or a signal service where you don't know if they're actually placing money on the line. That's a waste of time. If you're considering joining ours, we're going to drop another link here. Well, it's already there. Thanks, Chandler. Send us a direct message. If you'd like to chat directly with someone on my staff about getting a membership within our group, please click this link, send a direct message, and we'll hook you up with access to the Discord and get you a membership. So again, take advantage. Nick, can you take a look at the NASDAQ for me? Wow, look at that fake out. Again, remember, not necessarily a fake out. I mentioned earlier that likely what would happen is you would get a move one way or the other, and it would not follow through simply because we have so much more news coming, right? Later today, we have the Fed, we have Jerome Powell speaking, and later tomorrow, we have CPI. So think about this. The market moves, fundamentals are everything, okay? These are things that you can predict if you understand. I'm not saying you can predict what the market's going to do all the time. That's incredibly difficult. But there's a high probability that when you get big news, but there's more news coming, that the initial moves will kind of be muted until we get the rest of the news, right? It just makes sense. If you're somebody who, is watching the producer price index and you are short, let's say, you might have just covered. You might have said, well, I don't know what the next number is going to be. That's great that the market moved. I'll take that as an opportunity to just close out profits, right? That might have been what we just saw happen. So again, the producer price index was hotter than expected. That is a real fundamental thing that happened. But we also have the CPI and we have other things as well. So in terms of the NASDAQ, where are we at? Well, we're near all-time highs and inflation data just came in hot. So I'm a little skeptical. Now, I'm not a bear on the NASDAQ. In fact, I have some exposure to the technology sector through the ETF XLK. Okay, so I'm bullish XLK. This is a tech ETF. I think that the Fed will still find a way to rate cut this year. It's an election year. It's not a year that I want to be bearish on stocks. And I'm not bearish on stocks. I just think that for me, you guys want to know just roughly, I think I'm like 60% equities right now. And I know as of like last time I checked, I think I'm like 35% in gold. So relatively speaking, this is a high proportional amount of my account to be in gold, right? Gold, conservative investing, which I'm not investing per se, I'm trading, but, investing, a lot of times they say like keep like 5% of your account just sitting in the sidelines in gold, right? So I have 35. So I have a conviction towards being long gold right now. I think markets headed back to the all-time highs. I would not be surprised if CPI comes in cool that you do get a breakout to the highs. I just think it's probably a good, thing in my opinion to stay a little cash heavy and to stay a little bit more in things like gold that's a little less simply correlated to what the S&P 500 does, because I'm not bearish on the market, but I'm very skeptical. Earnings were good, yes, but inflation doesn't seem to be going away. And if we get a hot read tomorrow, I will probably even, maybe reduce some of my exposure to equities. I haven't made that decision up. But yeah, my point is this. If you're watching the indices, I would not be surprised if we see a period of more of a, sideways. I don't like to short indices. I don't think it's a very easy trade at all. But yeah. Ivan says, am I still right about my 30.3? You absolutely were, Ivan. You should have put the whole account on it. I never touched big GME. Look at this, up 120%. My goodness, this thing just keeps going. Craziness on the meme side. I put out a tweet yesterday. I said, everybody starts talking about GME again, and here I am still trading gold just like I was in 2021 when the first time around happened. Anyways, NASDAQ slightly lower here, S&P slightly lower, Dow flat on the day. The Russell's up slightly. That's kind of a weird one. Shouldn't the Russell be? Yeah, I mean, it got smoked initially, but has now jumped all the way back. So very interesting on that front. Again, I'm going to stay kind of where I'm at with gold. The euro, I'm not sure if I like that trade per se, but if you get hot inflation, I would expect that this drops down into the neutral territory. Okay, so bullish. Another reading has been bullish on 10-year bonds. Let me take a quick look at my TLT position. TLT probably not looking great today. Let me tell you that. Well, it came back. I guess flat here. Again, the big print will be tomorrow's CPI number, but PPI still had a big, a sharp move lower. But the thing is, this is just the first of 2 reports this week, really. Okay, so let's see. In terms of gold's holding its own, not bad. Silver coming back. Oil's down. Interesting. The 2-year yield jumped massively and then came back. Same thing with the 10-year yield. Very interesting. Again, earlier we went through just how much, when you start looking at this story, you have GDP data coming in cool. You have PMI data, both on the services and manufacturing coming in cool. Retail sales we get this week. Last time it was hotter than expected. The question is, with this latest round of retail sales data, which I believe we get tomorrow, is that going to come in cool? Right? Are we going to continue to see this trend of economic data cooling with inflation stubborn? You get to a point where it's like, okay, labor data, jobs came in light out of the US. Unemployment ticked higher in terms of claims. Job openings declining. Unemployment rate trending higher. Wage growth kind of slipping a little bit here. Inflation, though, again, if this one wants to load, this one's always weird on the Edge Finder. I don't know why it does this. It just has its moments where it just doesn't want to load. There it is. Okay, so inflation trending higher here recently. Okay, so you put this picture together, and it's not that exciting, in my opinion, for equities, especially when bonds are offering 4 to 5%. I mean, you just have to start to wonder. Earnings were good. That is true. That supports the stock market to some degree. But we have Nvidia earnings. That's another major one if you're watching the indices. But again, I just continue to like gold. That's where I'm at. It's on the setups. Again, top setups are looking at all that data that we just talked about, and they're pointing towards staying bullish gold. If I'm wrong about this, like I said, my stop loss has trailed in profit. I took this trade, 10 days ago or so, and I'm still in it. So we'll see how it goes. But that is the gold setup. By the way, if you guys want to try out the Edge Finder real quick, I'm going to drop a link here in the chat for you. You can try it for 30 days. If you want 30 days access to the Edge Finder, and you'd like some more information about how you can get set up with 30 days access, please click the link being dropped in the chat. When you click this link, guys, what's going to happen is you'll be taken to a place where you can fill out a quick application on the software. We want to make sure it's a right fit for you. So please just take a moment, fill out that application, and then shortly after, you'll receive a message from our team offering you kind of the details about what a trial entails. So if that's something you're interested in, please click the link in the chat right now. Okay. In just a moment, we're going to be joined by Kenzo from Extra Hot Forex. I'm curious to see what his thoughts are going into the kind of post period here. So real quick, stick around with me. We'll be right back after the break talking to Kenzo from Extra Hot Forex.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker Eightcap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to Eightcap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now back to the A1 Trading Show.
All right, and we are back to the show with Kenzo. Hey Kenzo, how's it going, man?
I'm doing great, thanks, and you, man?
I'm good. We got the claps for you today because it's fundamental, not Friday, but today is Tuesday. So We usually call our session Fundamental Fridays because Kenzo comes on each Friday. He's got his own YouTube channel. We'll be dropping the link here if you guys would like to check out Kenzo. Stick around with us. Kenzo always has some good stuff to say. So, Kenzo, what's your reaction to this hotter than expected producer price index number this morning?
Yeah, it's something that I was not really expecting, but not really surprising. But I think we're gonna have a limited move for now, because the most important one is gonna be CPI tomorrow. So I think today we're not gonna expect that crazy move, but tomorrow everything's going to change. But let's just expect maybe positive news. But if maybe we're gonna see some like crazy hot, like what we saw now, yeah, it's gonna be a different story, and the dollar's gonna gain that momentum again, and the likes of Nasdaq US 30s, they're gonna lose that momentum that we saw at the moment. And at the same time, it means that maybe they will be postponing about the rate cuts, and that is not gonna be a very good thing. And later on, I think in a few minutes, we're gonna have in an hour, I think we're gonna have Powell speaking. So if he saw those news, it's gonna be a different story. I hope maybe his statement is not going to be that bearish, but we will see.
Yeah, and again, as you mentioned, we have the producer price index this morning, but at the same time, we still have the consumer price index tomorrow, which is arguably more usually market impactful, because again, the producer price index gives us an idea as to what the kind of wholesale level, what the supply chain prices are looking like, which usually does trickle into what the consumer ends up paying. So in some ways, I find the producer price index to be very valuable. But here's the thing that I keep coming back to, Kenzo, is, this might not be the best week for stocks. If we get, for example, hot prints on CPI, stock market probably will hate that. But what about gold? For me, I think that there's not really, I said this earlier, and I could be very wrong, and it could, age like sour milk, but I don't see a very bearish case for gold this week. If inflation comes in hot or cold, the given is that the economy is showing signs of slowing. We went through some data just before you showed up, Kenzo, but GDP numbers, jobs data, PMI numbers, they're coming in lighter than expected. And at the same time, what's the bear case for gold? To me, I'm long gold because I don't really see one. If inflation is cool, then people will celebrate rate cuts. And if inflation is hot, people will say stagflation.
Yes, that's true. So yeah, on my side, it's also because if you check PPI previous maybe month or previous event, it's not really that aggressive economic news. Just now, just things are not going well. We start to focus much on that, but mostly CPI and not really much on the retail sales. But CPI is going to be the game changer. So mostly, if you check previous, we don't really see those aggressive moves on PPI. But it's going to be very important comparing what we saw today and what is going to happen tomorrow. If they're all going up, it's going to be a different story. But if maybe CPI starts to show the signs of going down, which I think is going to be difficult, because if manufacturers or producers are seeing the prices going up, for consumers, obviously they will have to obviously get higher prices, which means consumer price, it will be going up, and that at the same time it's inflation. So it's a bit confusing, and it's better just to wait for those news. But on gold, since they're still preaching about cutting the rates, I think it's very good buy. It's a very good buy. Plus we still have conflicts and stuff like that, and we have BRICS going on. I don't know if maybe you heard much about BRICS. So that BRICS organization, they are trying to introduce new currency, which might be backed by gold. So that is also a positive thing for gold. So, but we will see what will happen when time goes on. But for now, on gold, I'm actually bullish.
Yeah, I mean it's a good story. I do want to reiterate to the audience. Somebody asked, Charles asked, "Am I right to say, regardless of the result tomorrow, that gold would go up?" I'm not quite saying that because gold can always do what gold wants to do. It could go straight down, and Kenzo and I are expressing our opinions. But as always with this
Mm,
stuff, these are all educated guesses. No matter who you ask, nobody knows what the market's going to do. We're just making our
yes.
best educated guess based on, for Kenzo and I specifically, we look at fundamentals a lot. We look at simple price action. If you get tomorrow's number just red hot, the consumer price index, I think what matters most, and Kenzo, I'll ask your opinion on this too. It's not necessarily the figure, but how much the Fed feels that they can cut rates or hike rates. So, like, for example, if inflation comes in hot, and then what we hear
Mm,
from Jerome Powell is rate hikes are back on the table, then gold's going to go flying down, right? Because rate hikes
yes.
terrible for the story of gold. So, but the point is, right now the Fed seems loosely willing to basically say we still want to cut rates. We're looking to cut rates. That's like their goal is to cut rates and kind
Yes.
of relieve some of the consumer, but they need to see some of the inflation come down. So I think at worst case right now, the Fed will say we're just going to have to stay where we're at for a little bit longer, which is still fine for gold, in my opinion. But there's always the chance that the Fed says, actually, we may need to rate hike, which would be the incredibly bearish case for gold. You probably see back under the 2000s, even, in my opinion.
Yes, no, I really like that. Plus, on top of that, from that question of I see, regardless of whatever that happens, just to go through that also is sometimes people they will try, not specifically the individual who asked the question, but when we do the speculation or analysis, even Powell himself, he will say he's waiting for the news. So it's not like maybe we have to know exactly what is going on. Even someone who is in Fed, they don't really know what will happen next. You see, so even as we just do the analysis, which is something that we have to appreciate. So on that, I feel like also the news that we're gonna get, I don't really see them not cutting because another positive thing is even though the news were positive, but they were not really aggressively higher, and that it's also a good thing because it shows that even though we have positive numbers like PPI, the thing is we're not on the plus numbers or double digits numbers of growing. So which means even if maybe inflation is growing or is still sticky, but it's on a very slower pace unlike before. And that to them, I think is going to be positive. Even to us, or also on the market, we will see that the market was not really convinced about the sell because it shows that it's still positive, but not really aggressive. And that is also a good thing, you see.
Exactly. Yeah. And Kenzo, while we're on the subject of all these, inflation figures and Fed speak and all that sort of stuff, we do have again Jerome Powell speaking in just about an hour, which could be pretty
Yes.
market moving. Question for you: what else are you watching outside of gold? Any other charts that are on your radar today?
Yes. This week I was actually looking or checking US 30, NASDAQ, actually indexes. So also gold, but I was out on gold because the market was just reversing here and there. So at the
Mhm.
moment, I can't say we have any trade. We're just waiting actually until tomorrow. Then it's where we're going to take some necessary decisions. But at the moment, just to stay out of this crazy volatility, I think it's better to understand what's really happening before maybe I jump in the market because sometimes, especially on indexes like Nasdaq, US 30s, it's like guessing game if maybe you don't really have to wait for the news, especially when we know. I think it's next week or next week we have Nvidia earnings that
Yes.
can also be aggressive. So all those things, I think sometimes you just have to stay out. Then after the news, whether they are positive or negative, then we can jump on the market. But for currency pairs, I feel like it's still not really that easy to trade them. We were on GBP and Euro USD. So we are still on a downtrend structure, but we were just waiting for the news before maybe we look for any sort of a sell. And on this type of a structure, it seems like the dollar can be quite stronger, but we will see if maybe the market breaks out. So for now, I'm just staying out until maybe tomorrow.
Sure. Yeah, it's interesting. I mean, Kenzo, with everything going on and the inflation story and the economy slowing, and I think that for me, it just goes back to somebody's asking me in the audience why I haven't been trading FX, and you've kind of hit it on the head right there. Has been, there's this competing thing of like, when is the first central bank going to cut rates? And I think that maybe there's some trends that you could find when you're looking at like the Euro USD, for example. Like, I think that the ECB cuts rates before the US, but recently the economy out of the US has been showing some signals of slowing. So on the Edge Finder, I'm getting mixed signals on that. So for me, I'm kind of just like, I don't have a clear, trade on the currencies world. And as a fundamentalist, and I think you probably are in the same way of thinking on this, I trade a wide basket of different things, different symbols, different, assets and markets. I'm more loyal to the fundamentals than I am to a specific, chart. I know a lot of people love to say like, oh, I specialize in just trading the euro dollar, or just trading gold, or just trading the NASDAQ. But to me, and I think yourself as well, Kenzo, I find myself moving, market to market based on, what's happening. During 2022, I traded the dollar a lot. So sometimes a lot of people remember on my channel that during that time, I was very focused on FX. But since then, before and after that year, I predominantly trade indices and gold and stuff like that. So do you feel the same way, Kenzo?
Yes, actually, very like 100%, because now on my side, I think commodities, it's something that someone can look at. I was looking at oil, also, let's say maybe gold, even though maybe gold is just going all over the place. But I think they have perfect structures that you can follow. If maybe you are on oil, or some they even trade platinum or the other ones, I think it's their time to actually shine. It's easy to see what's really happening if you trade them. So to me, I feel like Forex itself, or currency pairs, and also maybe indexes here and there, they're gonna have this mixed moves, because we mostly focusing on the economic news like almost every week. So when Powell is gonna speak, the market will be going up. Tomorrow is gonna go down. Like today, in few hours, obviously the market will be going crazy maybe. Then tomorrow the market might change that direction and go in a different route. But when you check the commodities, they might not be really affected by that, you see. So which means sometimes you have to move your focus here and there. So I think you have to just move along. And it's difficult when you understand the news just to trade. When you know that these things affect this like that, it's going to be way too difficult for you just to jump on the market, even though the structures looks obvious. But you know that we have this tomorrow, we have that later on. It's going to be way too stressful just to jump on the market.
Yep, exactly. Kenzo, we also see a tick up higher in the VIX here in the last few days, just as markets kind of are preparing for, well, hey, you've got all this news. So you're seeing the VIX up here a little bit. You're seeing stock market kind of flat now. I mean, it's come back all the way from where it was. So NASDAQ, S&P back up here, the Dow, and gold, up nearly 0.5%. Silver up 1%. As you mentioned, oil seems to be trending lower pretty well. Pretty clean move there here today. Kind of rejecting at this level of resistance. It's been an interesting week so far, but as you mentioned, more to come. We have Jerome Powell speaking in an hour, and we have tomorrow the consumer price index and retail sales numbers. It's going to be a big week. I just want to mention all to everybody who is listening here with us live. Kenzo has his own YouTube channel. He puts out wonderful content. If you're looking for fundamental analysis as well as technical analysis, price action, all of that good stuff, I'm just going to ask that you guys quickly make sure to go subscribe to Kenzo on YouTube. His channel is Extra Hot Forex. If you're watching with us on Twitter, we're now streaming on Twitter as well. Kenzo, do you have Twitter?
Yes, I do, but I never use that much. So I'll try to check it if maybe I can be active on that.
Yeah. You totally should. I've been kind of increasingly getting more and more into Twitter. It seems like a big audience for this stuff. And I've been meeting a lot of different traders from all over the place. So definitely worth checking out. With that said, we'll leave it there. Kenzo, thank you very much for coming on the show. And I guess we'll see you back next week, man. Thank you so much.
Thank you very much, and your viewers, man. I'll see you next week.
All right. See ya. Again, guys, always good to have Kenzo show up and talk a little fundamentals with us. Kenzo has a ton of experience in the markets, and he's come on the show here for a while, and he always brings just a great perspective on fundamentals. I think we generally kind of have a similar style of trading, and again, I always like hearing what he has to say. Quick update in terms of where the market's at. The dollar index traded higher initially on the producer price index number, has now since given back those gains, trading about where it was, actually lower than this morning, trending down here today. And you might be asking why? Why, with a hot inflation print, is the dollar reversing? Well, yes, inflation came in hotter than expected. But the issue with that is that we still have a lot of stuff ahead. The Fed is speaking. Jerome Powell is speaking in, about an hour here. And if he's been on a trend of dovishness. So the question is the market just a little skittish about Jerome Powell? If you're trying to be long the dollar going into Jerome Powell's whatever he's doing, what is he actually doing? Let me hold on. Jerome Powell is speaking. What is he speaking at? Participates in a moderated discussion with Dutch central banker Klaas Knot, Dutch central banker, at the annual general meeting of the Foreign Bankers Association in Amsterdam. So anytime Jerome Powell speaks, he has the potential to drop his position on something or his opinion on something. And anytime he shares this opinion, the market listens because, of course, he's a very powerful person when it comes to influencing the monetary policy in the U.S. In fact, the most powerful person. So that being said, he's speaking in a little bit here. We will be live streaming that event. And I think we're going to have a stock segment in just a little bit with James. He's going to come on and just hang out for a little bit, give us a short break. But until then, we'll keep chugging along here. So, Jerome Powell speaking here, that could be big. I think what might be happening, and this is intuitively just off the top of my head, if you're sitting here and you're like short on the market, or you saw everybody sell their shares, again, Jerome Powell has been on a trend of being dovish. Like he's been wanting to cut rates. He's been blowing off, or to a degree, he's been less hard on the inflation stuff than he was. And so the market's been taking that as, okay, the Fed wants to cut. And if the Fed wants to cut, they might be able to look past some data. And I think that the market is saying, well, you have CPI tomorrow. That could be completely opposite to PPI. And you have Jerome Powell speaking. So again, people might have bought that dip on the S&P, or people who were short just covered quickly because they don't know what's coming. Jerome Powell is again potentially going to continue his dovish sound. So if Jerome Powell comes in dovish, stock market, of course, will celebrate that because they'll say, oh, rate cuts are still on the way, even though you got a little hot print on PPI. I think what the market will not ignore is if you get, in fact, a hotter than expected consumer price index tomorrow. If you get the double whammy, it's hard to deny. Because again, I showed this chart a few times already, but let me just reiterate that inflation, according to the CPI, has trended higher for the last 3 months. It's been on an uptrend. So if inflation is uptrending, as we go into the number tomorrow, the market is very much clamoring for, give us a lower than expected inflation report. We need to see inflation come down so that the Fed can start looking to cut rates. Because there's many intelligent people who still think the Fed's going to cut several times this year. Some people are thinking even up to 4 cuts still this year. Some are thinking 3, some are thinking 2, some are thinking 1, and some are thinking none. And some of the more, alternative extremes are people who think the Fed's actually going to hike rates. So forecasts are all over the place. But what I think sets a hard line for everyone tomorrow is the CPI. Because if CPI comes in, let me paint a picture. If CPI comes in like this, we have Houston, we have a problem. Because then what you have is you have 4 months of consecutive increasing inflation. And then it starts calling into question, is the Fed even restrictive enough? And that the market would hate. So I don't know what that number is going to be, but the producer price index did come in hotter than expected. So will that have some impact on CPI? We'll see. Again, if you get even sideways inflation, I think, what are the forecasts for inflation tomorrow? Let's go look at that together. So tomorrow morning, we get the consumer price index. I need to change my time zone. Hold on. Let's do Eastern Standard Time. Okay, so tomorrow should be 8:30. Yep. Tomorrow we get the consumer price index, and forecasts are for 3.4%. Previously it was at 3.5%. So let me just paint a picture. If you get 3.5%, no progress on an annualized basis, the market will hate that. If you get 3.6, the market will scream and pitch a fit. And if you get 3.7, then we'll just shut off the monitors and go home. I'm just kidding. But, it is possible that if you do get a hotter than expected print, the market will probably sell off. If you get a 3.4, you get a 3.3, 3.2, probably the market celebrates that. And they say, okay, we got the inflation story cooling. And at the same time, inflation cooling, economy cooling. Let me see in terms of, thank you for this. Russ says that the prior PPI was revised, so CPI could be revised downward as well. Let's look at that. The producer price index. So this was core, revised down, month over month, revised from 0.2. Oh, they did revise that down. So you had some hot print, but also they revised the previous one lower. So that would also make sense why you're getting a mixed response here. Gold is up nicely now. Second buy entry is looking okay for now. I added a second trade yesterday in the VIP room. My first entry was about 10 days ago. I added a second one yesterday to the gold trade. We'll see how it goes. Let's check in on our friend GME. What's going on with GameStop here this morning? GameStop is up just a casual Tuesday morning, 120% on the day. That's crazy. Does anybody here own any GameStop or trade GameStop? It's been crazy to watch. This thing has just shot up to the moon. I talked yesterday about taking a small, for fun short position. I'm glad I didn't, because it would have been not a big trade anyways. But my goodness, this thing just flew higher. But I think that, if I do still take my experimental short position, I'm probably just going to wait a few days, watch what happens. Because again, I don't really, I don't make my money trading these sorts of things. I can tell you that right now. I don't make my money playing with things like GameStop. What I mentioned yesterday was taking a really small short position simply for the fun of it. And I'm talking a really small, like 20 shares, like talking about, for me, that's like that's like so small. But now it might be, now I might need to do like 15 shares or 10 shares since the price doubled. Just crazy. Yeah. And look at that. AMC also jumping up. Look at AMC. Oh my goodness. It's up to $12 almost. And I'm not going to lie. I start wanting to short these things when I look at them. So I got to stop looking at them because I look at them and I see the company hasn't changed at all. You have a meme like fundamentals wise doesn't quite make sense. But that's not what, the Redditors are trading based off of. They're trading based off of the hype and the fun of let's screw over the system. And, in the very short term, they might have a little blip of that. But then you guys know the Matrix doesn't lose in the end. In my opinion, GameStop is a $15 stock and it will go back there. It just may take some time. It might be next week. It might be 3 years from now. But in my opinion, GameStop is a $15 stock. That nothing has changed fundamentally about the economy. I mean, about the stock. It's just that there's a ton of hype because the Roaring Kitty, he came running back and made a post on Twitter that the market got super excited about. So, you're seeing a huge jump on the stock, but in my opinion, it's not an investment that I'm going to make. He posted a photo and it blew up. Yes, that is the news. That is the whole reason right there. He posted a picture of a guy sitting up in his chair holding a presumably a controller, a gaming controller, I think. And everybody got super bullish because they said he's back. But again, I think that I don't think I'm saying anything crazy by saying that's not really a huge reason to believe fundamentally that GameStop has changed. That's my opinion. Anyways, we got to admit that is kind of a perfect candle. This is what Frank would say.
Perfect candle. That green candle right there.
I love that sound. Frank is in Europe. If you guys are missing him, he usually comes on the show a couple times each week, and he's in Europe. He's doing a travel with his family or a trip with his family, and seeing cool places. I made the joke yesterday. He's having a cooler day than Chris and I were. He was in Rome yesterday. I think he's probably still in Italy, which is I'm just jealous. Maybe if I had just bought GameStop, I could just take all the money and go join him in Europe. I'm kidding. Again, I don't really touch that stuff. I never got involved in the hype. I'd been trading for years before the GameStop hype, and I watched so many people who had never touched the markets before come in, get excited about it, and they walked away with like 5-figure losses. So please be careful with that stuff. Again, producer price index came out this morning. They revised the previous one lower. The latest one came in a little hot. So kind of a mixed report. And I made the point earlier several times that the overall picture for me on gold remains bullish because high inflation plus slowing economy. I like the story for being long gold. And I also made a tweet kind of poking fun at the GameStop stuff. Back in 2021, when GameStop was going crazy the first time around, I was trading gold and it was like super boring and it was like the lame thing to be doing. And I made a tweet yesterday that here comes 2024, GameStop is back. All those people who lost a bunch of money are coming back now to the stock. And I'm still doing the same thing. I'm still trading gold like a boomer, trading this, I know a lot of people think gold moves a lot. Gold actually moves like nothing. Gold moves very small relative to more volatile assets. If you compare the percentage moves of gold to things like Bitcoin, to the stock market, gold moves very, very little on a percentage basis. It's just a very interesting and romanticized, market. Everybody loves trading gold. I do too as well because of its, track record of being loved by humans for 5,000 plus years. So anyways, stock market's still flat on the day. We do hear from Jerome Powell in about 40 minutes. I think James is getting into the office pretty soon. Once he's here, we'll go ahead and set him up with the show, which would be fun. Americans travel to places like Oklahoma. Everybody loves to bash on Americans for the travel, but you have to understand too, our states are like European countries. Like the distances are comparable. So like when you have somebody going from, London to, France, or London to Scotland, like that's like us going from where we live, Georgia, to like Virginia, or Georgia to like, Miami or something like that. Like everybody trashes US travel, but our country's ginormous. So we end up, our travel is still probably a similar distance. Takes me 2 days to get out of Texas. That's what I'm saying. Texas is a massive state. Okay. Oil. Yeah. So oil's interesting today. I don't necessarily have a bullish or bearish take on oil right now. I was very bullish for a little while. I made some good money, and then I took a loss on this one. I haven't touched it since. And oil, I believe, is not getting any setups on the Edge Finder. Let me see. Yep, it's not on our top setups. If I add the neutrals, we can see where oil is at. Oil's got a neutral -2. S&P's got a neutral -3. So these ones are there's nothing to touch there for me. Dow is flat. NAS is just slightly neutral. Silver, neutral. Again, setups that I see personally that I really like is the TLT, gold, maybe the euro on a pullback on the bullish side. I don't know. I think that one just depends on this one depends on CPI tomorrow. If you see euro dollar pull back a little bit, there might be a setup here, in my opinion, just because recently, again, the trend would suggest you have a lot of economic data coming in light, but it's going to be dependent on inflation. Because to be fair, if inflation comes in really hot, you still might see the dollar strengthen again and trend lower on the euro dollar, right? Stronger dollar, weaker euro. But that would, again, entail that tomorrow you get like a really strong, higher than expected inflation figure. Bitcoin's trading a little bit lower. I mentioned I have a very small short position. Here's my very small short position. I have 200 shares on the short side of IBIT, just a Bitcoin ETF. Thought process on the Bitcoin world is that, again, with a potentially slowing economy, with unemployment ticking a little bit higher, I think that the consumer could be starting to feel a little bit of the effects of inflation, and maybe that impacts the demand for Bitcoin. That's kind of my theory. At the same time, it is a risk asset, and so it is a bit of a hedge to my existing long positions in the stock market. It's a very small trade, so it's really not that much. But if the market were to sell off, I'm talking about the stock market, Bitcoin would likely sell off too, and in an even more aggressive way. So with my small position, I could have just a little bit of a hedge on there. That's my theory with that. Dollar yen continues to trend higher. This one just looks so strong. Dollar Swiss, pound dollar, euro dollar, silver, gold. Again, everything kind of resetting here after the news. Made a big move lower, jumped back up. They revised the previous number lower for the producer price index, and the latest number came in hot. So it's kind of a mixed response, as well as coupled with, we have Jerome Powell speaking soon, and we have the consumer price index tomorrow. Why is gold moving with hot PPI numbers? Bilal, good question. The reason is because they revised the previous number down. So that's cooling inflation data. But then the latest one came in hot. So it's kind of a mixed picture, right? So the mixed picture goes back to our initial theory with this. And what I mentioned earlier was, okay, the economy is a given. We know that's starting to show signs of cooling. all of our major metrics that we track within the software, jobs data, PMI data, GDP numbers, they've come in cool. Okay, so that's our given, right? Real quick, before we push on with this concept, ignore this for a second. Economic data, again, GDP has come in light. That's good for gold, right? Remember, slowing economic figures, we factor that in our scoring system for our trading, guide here at the Edge Finder. GDP numbers coming in light, that's positive for gold. We also know that the PMI numbers, both services and manufacturing, missed on expectations. So slow down the economy, good for gold. So positive so far. Retail sales, we get the latest figure tomorrow, but the previous one was pretty strong. So that's negative for gold. Okay. But tomorrow, again, the latest data could come out and flip that around. Okay. But then you look at inflation, we'll get more of that tomorrow. Jobs data has come in light. NFP was a miss, the first one in several months. And yields have been on the decline. Okay, so all of these things considered, the economic data, again, this is why we use software to pull in economic data. Trying to do this all off the top of your head is just silly. If you want to trade with fundamentals, you need tools to help you. It's just, there's too many things to keep up with in your head. You need to use software. That's why we've built the Edge Finder the way we have. So all of that to say, inflation data comes out tomorrow. And so yes, you had the producer price index come in slightly higher, but the previous one was revised lower. So it's kind of a mix. But then we go back to our known. Our known is that the economy seems to be slowing down a little bit. So buy gold, right? That's the idea that's generated by the Edge Finder, right? That's the consensus. If that made sense, can you guys do me a quick favor? Just type yes in the chat if my breakdown on that, again, slowing economic data is positive for gold. It incites a little bit of concern about the economy. Gold becomes more of a safe haven, more of an attractive asset. If that makes sense, type yes. Just let me know. That really helps. Also, you can let me know by hearting if you're on Twitter or liking the stream if you're on YouTube. Thank you very much for that feedback. I appreciate that. Okay, so again, the economy starting to slow in combination with inflation that has been sticky. That's been the recent bias. But there's also, for tomorrow's data, a question mark. Today's data was kind of mixed, right? Tomorrow's CPI is the question mark. But most things already point to a bullish perspective on gold based on the fundamentals, based on the Edge Finder. By the way, if you guys would like to try out the Edge Finder, we're going to drop another link here in the chat. Click this link if you'd like to apply for a 30-day trial of the software. If that would be something that would be beneficial to you, please take a second, fill out this application. You can try the tool for 30 days. We'll give you some information about that. If you fill out this application, someone from my staff, a real person, will speak to you about the tool. They'll reach out to you, see if it's a fit for you. If you're aspiring to use fundamentals, again, take advantage of this because you just can't do fundamentals all in your head. It's just too many things. Unless you are staring at this stuff for 4 hours a day, it's really hard to do all that in your head. Use software. Why make it harder on yourself? So again, check out the Edge Finder. It's a tool we've worked really hard on for the last 2 years. We would be excited to let you try out the tool to see if this would be a right fit for you. So make sure, click this link, try it out, 30 days. And with that said, what we're going to do now is we're going to take just another quick break. We're going to say hello to James, who's going to be doing a little bit of a break here for me. I've been doing an hour and 15. So I'm going to give James the stand here for a moment, and we'll be coming in right after this with James.
Don't go anywhere. Coming up next, we're talking more stocks and adding to the A1 Trading Community Portfolio Live. Remember, if you're looking to start your own stock portfolio for long-term investing, you can get free stock shares just for signing up with our partner broker WeBull. We'll drop the link in the chat now, or you can find it in the description down below. If you're not in the US or the UK, don't worry. You can still buy and sell stock CFDs with Eightcap, which is also linked below. Now, let's add to the portfolio. Hello. All right, new microphones. We have new microphones in the studio. I just made so many funny jokes you guys would not believe. The most witty pirate jokes you've ever heard in your life. I said I was going to raid Nick's trading account. Not as funny the second time around, but we're keeping the pirate theme alive. I got the bandana on. I haven't dressed up yet for pirate theme, and I saw that stuff laying in the back, and I thought, you know what? Today's my day. I'm going to dress up. So I got the bandana. I got the sword, and I'm ready to attack the markets. Okay. So here's the deal. For all 800 of y'all watching, if you have not seen this before, what this is our A1 Trading community stock portfolio. And when I say community, I mean it is up to you guys to vote on what we buy and what we sell in this account. Now, check it out. All of this stuff here is stuff that you guys have voted for in our Telegram. If we could drop the link to the Telegram really quickly, this link is going to take you to our Telegram. It is 100% free to join. And inside of the Telegram, we can drop polls where you guys vote on what we buy and what we sell. And whatever has the most votes, we'll end up buying. Right? So you can see, you can see in the market value, that's roughly how much we've spent on each thing that we've got here. So you can see, like, we put $40 into Tesla so far. We've gotten a $5 return on that. We've spent $40 on Google, $3 return on that. So you can see we're buying partial shares because a lot of this stuff is very expensive to own a full share of a lot of these stocks. We started with $500, and here's where we're at. We are down to our last $30 in the trading account, and then all of the money will have been spent, and it'll all be sitting in these assets. So we'll have to potentially add more to the account, or pick and choose some stuff to sell and then take that money and invest it somewhere else. We're gonna have to figure something out here pretty soon. So this is going to be, I think, the last time, at least for a little bit, that we are buying stocks for the portfolio. Now, another thing that we could do here today that would give us a little bit of money back is we could sell something. Now, there's nothing in here particularly that I think we need to get rid of. Our worst performing stock at the moment is Toyota, TM, Toyota Motors. And the open the open P&L on these is not great, down 8% on all of those. But we have such little money invested. We're not losing too much. And, this is investment. This isn't day trading. We've got no stop losses open. We're here for the long haul with this stuff. We're here for the investment. So let's check out some of our worst performers, and then I think that we should do a poll. Should we buy or should we not buy? Should we sell? Should we sell one of these positions? So, and in fact, let me pull it up on TradingView as well. So I'll mention also, you can see here that we are trading on WeBull. WeBull is an awesome trading platform. I've had a lot of fun building this portfolio, and there's a lot of cool stuff that you can take a look at on WeBull. So if you're interested in creating your own stock portfolio or doing some investing of your own, check out WeBull. The links are down in the description below for that. So thank you very much to WeBull for that. And another cool thing that you can do with WeBull is you can actually link it directly to your trading view. So I'm actually pulling up here just so that we can get a little bit of a different look here at the chart. You can see that we entered here, maybe on this candle here. That's not where we entered. No. Wait a minute. Psych. Hold on. Where is it at? There it is. Connect. Guys, don't look at my phone number. Guys, if you got my phone number, don't use my phone number. Please. Hold on a second. That was funny. If my phone starts blowing up. Whoa, wait a minute. What? Hold on. I think I typed in the wrong password, and we are loading. It's just loading. All right, never mind. Oh, okay. Yeah, it's not working. Never mind. All right. So this is what Toyota's doing. We entered here. It's done nothing but fall since then, and there's a lot of gaps in this chart too, which is kind of interesting. Let me see. What were the other two that were down 8% as well? IBM and DoorDash. IBM is like the most mysterious company to me, because like, what do they do? Their logo is everywhere. Yeah, IBM. That's what I did. IBM. There we are. We entered here. Oof. Yikes. Although it's not as low as it has been. It's actually turned around just a little bit. So that's a good sign. And the last one, DoorDash. That's right. Oh, DoorDash just took the bottom spot, actually. Dash. We entered here and like immediately gap lower. But similar to IBM, it's kind of turning around a little bit. Okay. All right. Should we sell one of our stocks? Can we put that as a poll in the Telegram? Should we sell one of our bottom two performers and get a little bit of money back? DoorDash or Toyota? Putting the poll in now. Should we sell or not? Should we sell or not? TM, Toyota, Dash, DoorDash. Next option, don't sell. Okay. So in order to get a little bit more money back into the account, should we sell or not? Toyota, sell DoorDash, don't sell anything. Got it? I'm putting that into the Telegram right now. So if you use that link that we put up here, where's our Telegram link? Here it is. If you use this Telegram link, you can join for free and you can vote on if we are going to sell or not sell one of these. Buy GME. Is GME still up? I was looking at it pre-market, but I haven't looked at it post-market. It definitely is. It is definitely up. Yep. That is so ridiculous. Man, if we could have bought GME before the market opened, that's something I would have done. However, I have no faith that this thing is actually going to continue to rise like this, even though I know that in the past it went like way higher than even that. It topped out at its very top at like, okay, $120 a share. So we're only at like half that, but still. There's just no way it's going on another run like that, right? If you wait, confused. What are y'all arguing about? Sell the whole portfolio is $500. Okay. Yeah, I don't have faith in GameStop. Sorry. I think it's fun. And it's going to be fun for another couple days. But the odds that we have another ridiculous rally like the one that we had in 2020, 2021, I just think that's a once in a lifetime type of thing, you know, that the Redditors and the community and whatnot lifted GameStop so high and just, you know, messed up everything. I don't see a world where they get away with it twice. They might have a little bit of fun here, and it may even go a little bit higher than this, but it won't be for long. It's not going to last. This is a move like this is like get your money quick and get out, which is not exactly what we're looking for. We're looking for investments. Use the $500, buy a put on GME and call it a day. That is something that is something to consider, which I know Nick has talked about that. Nick is considering doing that. And that idea I do like. However, again, that's not the point of this portfolio. The point of this portfolio is for you guys, the community, to vote on what we buy and sell. And so if we make money or lose money, it is up to you and it's all your fault. Okay? Okay. All right. So we have 55 votes in. 55 votes in. If I'm being honest, even though they're not performing great, this is an investment account and I don't want to sell yet. We already sold Reddit, which RDDT. We owned Reddit at one point. And I can see now that I've made a mistake. I haven't checked on the Reddit chart in a while, but we sold it like here, literally. We bought it here, maybe around this range. We bought, and it went all the way down and just kept going down lower and lower and lower. And I feel like we sold it like here, right before the turn. So that was a bad move on my part. And all the more reason not to sell either of these. Although I have a feeling that you guys are wanting money back. So let's see. No, don't sell. Okay. You guys agree to hold. All right. Diamond hands. Diamond hands. We're holding Toyota, DoorDash, and whatnot. All right. So with that being said, we only have $30 left in the account. We only have $30 left in the account. And I think that we should put it back into the account because we already have so much stuff here. There's so many different things making up this portfolio that we need to continue to invest in what's doing well. So for that, I'm going to make three quick polls, and you guys vote. These are all going to be big names. So I'm curious to see what's your guys' favorite. All we're going to do is we're just going to vote on some stuff that we already have and buy a little bit more of each one. We're going to put $10 more. 3 different polls we're going to do, $10 more. First poll, I already know what's going to win, but maybe we can keep it close. Let's do this. Let's do this. Let's do this. And let's do this. No, this is a bad poll. This is a bad poll. Let's do. What do we want to add? What do we want to add? Should I make it a little tougher? All right, I'll make it a little tougher. You guys are goofy, man. You guys are goofy. All right, check it out. I'm going to put the first poll in. What should we buy? Are we buying? I'm going to save the big one for last. CD. McDonald's. I'm going to buy WMT. Walmart. Are we going to buy... Ooh, what was else on my list? Oh, okay. Are we going to buy HD? Home Depot. Depot. Or are we going to buy... Are we going to buy this one? You tell me. What are we going to buy? I can't imagine. I can't imagine what we're going to buy. All right, let's see. Let's see what you guys say. Hey. You guys are just fighting in the chat. Come on now. It ain't that serious. All right, while y'all are working on that, I'm going to get the second poll set up. Because we already know what's going to win. What was that? Oh, it was a Nick.
What's up, James?
What's up?
I gotta come in and be dad for the stream for a second. Guys, please stop fighting in the chat. And also, do us a quick favor. You know, in terms of guests or, you know, whether it's a guest that we bring on to the show or somebody else, please be polite to our guests. Please be respectful. And if you're not, we're going to have to start banning people left, right, and center because otherwise our guests won't come back on anymore. So let's show some kindness in the audience, and otherwise, you out of here.
Hey, Iggy, how about you leave instead? There you go.
Oh,
Oh, he's
no,
gone.
Iggy was banned.
Oh, man.
Dang.
Oh, man. Yeah, H Ball out changed his tune real quick. He didn't want to get banned, too. You guys didn't know I had that power. I've been sitting over here, you know, minding my manners. I could have banned y'all.
So James, what do we end up buying?
So the first poll was actually, I looked at our top 2 worst performers. Well, these 3 have been swapping spots with each other. But I was going to say, are we selling DoorDash or Toyota to get a little bit of money back into the account? Because we're only down to $30. And the vote was actually don't sell. So we did not sell anything. And now I'll let you, this is our poll right here for what we're going to buy. I can't imagine. So we got
McDonald's, Walmart, Home Depot, or Tesla.
I can't imagine what it could be.
I'm just going to take a wild guess here, James, and say it might be Tesla.
I think it's going to be Tesla too. I don't even think I need to vote for anything else. Yeah.
Look at that. How many, what are we looking at in terms of Tesla positioning? Do we already have,
So we actually own more Tesla than anything else in the portfolio.
Okay.
That and Google, we both own $40 worth of Tesla and Google. And for both of those, that's about 1/4 of a share.
Yeah.
So net 0.25 there. So We're going to add a little bit more into Tesla. Add a little bit more into Tesla. That is our top performer. Oop, not market, stocks.
Which has been interesting, James. You know, the big thing about Tesla is like in the next 10 years, do you think that people are going to be driving more electric cars or less electric cars?
You know, my dad just bought an electric car last week.
Did he really?
He did.
What did he buy? Do you know?
He got a Ford Mustang EGT.
Okay. Does he like it so far?
Yes, it's very, very cool. It's a 2023 Ford Mustang EGT.
Yeah.
And it's it looks kind of similar to a Tesla, but he's got the nice sport mode and everything on it. Ford Mustang EGT. It looks kind of similar to a Tesla. This is what it looks like right here.
Mm-hmm.
Whoops. So that's it there. The whole roof part of it is actually glass, I think, similar to the Teslas. It's got its little charging thing right there, a little light up Mustang sign. It's very cool car.
That is awesome. Yeah, I feel like it's a trend. I've also seen a lot more Cybertrucks on the road recently, and I still
Have
think
you
they look
seen any in
goofy.
person?
I've seen a couple in person, but here's the thing. I see them and I kind of think that they're goofy, but you know what I also see, James, is I see a trend on social media of people thinking they're cool. Like almost like it's dripped out if you have a Cybertruck that you're driving around in. And you know, I think like I've seen it, like specifically what I'm thinking of is I've seen it in like the rap community, like some rappers that I follow are like big into the Cybertruck. And I'm like, hey, you know what? It's kind of cool. I don't know. I can't lie. When I see it, I'm like, that's kind of cool. Not probably a vehicle for me, but it is what it is. Also, I just want to mention before you respond to that. So we've got Jerome Powell speaking in just about 7 minutes or so to go. Chandler, I'm not sure if you can find that stream anywhere, but maybe we can try and see if we can find that ahead of time. But anyways, James, what do you think? Cybertruck, is that the future? I know you're already signed up to get like 3 of them, right?
I am signed up to get 4 actually, for one for each member of my family.
Nice.
I like the Cybertruck. It's different. It's weird.
Yeah.
But I like bigger cars anyway.
Yeah.
I'm a bigger guy,
big
so
dude.
I want
James
a bigger
like
car.
6, like what? 6'5", 6'4"?
I'm 6'7".
Geez, 6'7".
And
He towers over me.
So big bulky car sounds good to me. I like everything bigger.
You know, James, what I think might be, I could be wrong about this, but maybe like in the late 2000s, the Hummer was the thing. Maybe in the like mid to late 2020s, maybe the Cybertruck is that goofy thing that so-and-so's dad has that everybody secretly thinks like, whoa, that's kind of cool. Like maybe that's what's happening. I don't know.
That's true.
Like if you asked me, like, is this truck going to take off and be popular? I would have said no. But again, I've been wrong before, and I don't set the trends, and I'm certainly not on the cutting edge of fashion. So, you know, who am I to say?
You know, I kind of thought the same thing. When I first saw it, I thought it was a little bit too ridiculous looking. I wasn't sure how I felt about it. And then as I saw more and more stuff, I was like, you know what? That's pretty cool. And then ultimately I came to the decision, you know, why would you not want to drive a bulletproof, you know,
I mean, it's
like cinder block tank.
You know, the one thing that shocked me about it, James, is that it's huge. It's really big. When I saw it in person, I was like, oh my gosh, this thing is way bigger than I thought it was going to be, which added to, I think, to the cool factor. I think if it was like a small vehicle, I don't think it would be very cool, but it's like big and alien looking and clunky. And again, not really my cup of tea, but when I see it, I have to kind of say like, dang, it's a cool looking thing. I don't know.
Now, you used to drive a truck back in the day.
I had a GMC 2003 Sierra. It was an old black pickup truck.
Was that so? You've seen my truck. Was your truck, do you think, bigger or smaller than my truck? I'm trying to gauge the size of the Cybertruck because I didn't think it would be too much bigger than the truck I already drive.
So compared to your truck, I'm going to say it's probably similar. I think yours is like lifted a little bit. Like, I think your truck is like slightly bigger than mine. I think the Cybertruck is about a comparable size, maybe like shorter, but still like bulky wise, very similar. I don't even know if you can get a Cybertruck lifted. Anyways, we are coming in here to the meeting here in just a moment, or the speech that Jerome Powell is about to give. We've got it pulled up. Don't go anywhere, listeners. We've got this stuff going on. James, you're doing one more vote here.
Yeah, I'll do one more, and then we can wrap up because I know that Jerome's about to pop out.
Also, James, have you talked about GameStop yet?
I did talk a little bit about GameStop.
So we bought like half the portfolio in it, right?
That's what they were telling. That's what they wanted me to do. That's what they wanted me to do. But
maybe we could do another vote for a meme stock at some point. I don't know.
I was in a similar. I think I'm in the same boat as you. As if I could put puts on GME that would expire, a month or two from now, I definitely think that that's the smarter move, because I just don't see a world where they get away with it twice. I think that they can make a good run at it, and they already have made a pretty good run at it.
Mm-hmm.
But this is not long-term investing. This is not something that's going to hold, that strength, that price per share for a long time. This is a quick.
I think it's a $15 stock. Just it could go to 100 first. It could go to 200 first, but I think it will end up being a $15 stock because it's still just kind of a dying business in a digital age. So
this momentum will not last.
Yeah. I typically agree. We'll see. Again, I think people will have their fun with it, but I'm in a couple group chats and like already they're freaking out about this dip, and it just brings back so many memories of, like 2021. It was like the most emotional people who've never touched the markets before, who really should not be touching the most volatile part of it. They get caught up in the hype. So for those of you guys who are new to the markets, if maybe you weren't trading around 2021, here's how it ended. Here's how it started. A lot of people got hyped. A lot of people got in. Some people made money. Maybe small handful of people made money. And the majority of people, a lot of people I know even, took like 5-figure losses and wrote off the stock market as a big scam. It's only a scam if you treat it like a casino. I mean, it is a casino, but you can play it way, more. You can put the odds in your favor by playing the slow and steady approach and, being long-term focused and all that to say. James, what's our last stock here? Did we put out the vote?
Yep. So I've got the poll up. These are, again, some of our best performers. So we're going to put a little bit more money into something that's already performing very well. We got Google, Coke, Marriott, Netflix. So we got 28 votes in. We got just a few more minutes here. So guys, if you want to get your votes in really quickly, this will be the last one for today. We still have, I only put $10 into Tesla. So we do have $19. What do you think, Nick? Should we put all 19 into whatever wins the vote, or should we save a little bit for?
So I got one last idea for you. Let's do like 10 on this, but then what we could do is the last 10, we could ask people, are we short or long GME? That would be kind of a fun one.
Should I drop that poll, short or long GME?
Yeah, we could do that. And Chandler, whenever we get JP on the stand, just take over the stream. I can see he's working on it. While you're writing that up, James, I'll just give a quick update. Guys, I am still long on gold. First entry was like 10 days ago. Second entry, I built into the position. I have a second trade now. We are floating $4,600 on this trade. We'll see how it goes. Again, this one's I added to the trade because when we look at kind of the overview here of the Edge Finders analysis, the big thing here is economic data has been showing signs of cooling. You look at the advanced GDP numbers, manufacturing and services sectors, PMI numbers, jobs data has cooled off a little bit. The overall story seems to be right now a trend towards a cooling economy out of the United States. At the same time, if inflation stays sticky, I like the story for gold. So I'm long gold. Again, bullish reading on the Edge Finder currently. So I'm staying long gold. stops are trailed into profit on this one. So if the market rolls over and breaks support here, then I'm going to go ahead and take a profit on the first trade and a small loss on the second trade. So we'll see if that one wants to run, and we'll go from there. I think we have, nope, not yet. Chandler's got the just waiting on Powell to enter the stage. Okay, cool. James, what's our last vote here?
So Google won pretty convincingly this poll here with 72% of the votes so far, and selling GameStop, which is actually, that's a surprise to me. Selling GameStop.
I did not expect that either. You guys are going to turn us into the bad guy. You can't be shorting.
Hey, I like, that's what I voted for. I wanted to sell it.
James, that just means you and I are part of the Matrix.
Yeah, you're right.
We're Matrix.
Still, we're too
we're minions in the Matrix.
We're too blue pilled.
That's funny. Still waiting on JP, guys. Again, we've got the inflation numbers came in kind of mixed this morning. Jerome Powell is going to likely speak on what's coming next. Anything he says about the inflation story, etc. We'll see. Anyways, let's take a look at GME as we wait on your votes there to come in. GME gapped up today, again, massively. And I just got to look at this for a second. So if I go over to GME options today, just for fun, my opinion, you don't want to be buying options on this because that's danger, danger, danger. Here's why. If you're looking at calls, look at this. This is so weird. So James, I know this is, you can't even buy a call above 57. So we're trading at 56. This is so weird. I've never seen this before in options. You can buy puts all the way down, but you can't buy calls much higher. So maybe that's the Matrix just saying, ha, we got them. They can't buy calls above 56, but I don't know. Anyways, if I go to buy a call, guys, I'm paying almost $14 in premium. That means the strike price, 57, you're only break even past, just to break even. The price has to go to 71. These are horrible pricings, in my opinion. In fact, almost like worth selling a call because, again, everybody's piling into the calls. They're bidding up the premium price. To me, that is crazy stuff. I mean, GME totally, I would actually, it's just been halted too. GME could go up to 100 to 200 before it goes back down. So I think that, Redditors and people who are super bullish on GameStop, they're not trading it based on fundamentals. Everybody knows, I think, the company is a dying company. It's an out age thing, but right now it's kind of like this play for momentum, this play for hype. And again, you look at the longer term story for GameStop, it cost a lot of people a lot of money, a lot of mistakes, and a lot of people thought the stock market's a scam after this one. Because again, everybody got so hyped up last time around, and so many people lost so much money who, know nothing about the markets. What I would just say is it can go up, but just understand the fundamentals haven't changed for the company drastically. I don't see, GameStop suddenly dethroning, Microsoft and Activision and Steam and all those things just because somebody posted a picture sitting up in a chair.
That's the most ridiculous part about it too. I was trying to explain it to my roommate last night, and really there is no explanation other than
Hello
it's just
there.
the internet.
It's a pleasure to be here today in this wonderful venue.
All right, James, we got JP. Are you gonna stick around and watch with us?
Acting US economics editor.
I'm gonna back out.
Okay. And I'm here today with President Knott and Chair Jay Powell. Chair Powell, I'd like to begin with you. Could you give us a brief summary of the US economy and where Fed policy is right now?
Thank you, Claire. I'd be delighted to. Let me say it's great to be here. Thank you for being here. And Klaus, thank you for this great visit I've had here to Amsterdam. It's a pleasure and an honor to be here. So the U.S. economy has been performing very well lately. We had growth last year of just over 3%, quite a strong year. And it's driven by a number of things. I would point to a very strong labor market where you've got rising employment, you've got rising wages, so disposable income, consumers are spending. Generally, households are in good shape financially. They're not over-levered. And so we see a good picture. Consumer spending has held up very well. As well, business investment has been strong. Businesses are seeing opportunities to invest, and that has helped. I would also point to a fairly large influx of immigration into the country over the past couple of years. And those people are joining the labor force. We're experiencing still a labor shortage in many industries, and so there are jobs, and they're going to work and they're consuming. So that's also boosting growth. So overall, a good picture looking at the data so far. The labor market is very, very strong. It was, I think, overheated a couple of years back.
Quick shout out, Tony, Jake,
back in
Jared, anybody watching
into
from my high school crew who heard me talking about GameStop.
And now I think if you look at a broad range of data, you could say that the labor market is about as tight as it was before the pandemic in 2019. And that's good. Real wages are now positive. And unemployment has been below 4% for 27 consecutive months, something that hasn't happened in a half century. So labor market very strong, and again, signs of gradual cooling and rebalancing, so that supply and demand of workers is coming back into balance, which just as we would want. Inflation, it's worth starting with the fact that on a 12-month basis, headline inflation got as high as 7.1%, is now down to 2.7%. Core inflation got as high as 5.6% and is now at 2.8%, so it's down by half. That progress, though, really happened over the course of last year, particularly the second half of last year. The first quarter in the United States was notable for its lack of further progress on inflation. We had higher readings in the first quarter, and higher than we expected. We did not expect this to be a smooth road, but these were higher than I think anybody expected. And so what that has told us is that we'll need to be patient and let restrictive policy do its work. If I turn to the outlook just for a second, I would say we expect continued growth, 2% or better. We expect the labor market to continue to be strong, but to move further and further into balance. And I expect that inflation will move back down on a monthly level, on a monthly basis, to levels that were more like the lower readings we were having last year. I would say my confidence in that is not as high as it was, having seen these readings in the first 3 months of the year. So we're just going to have to see where the inflation data fall out. And I'll stop there with the economy. Thanks.
Thanks very much. We'll be digging into some of that later in the discussion, but now I'd like to turn to President Knot. Could you maybe give us a little bit of a sense of how you judge the state of play in the Eurozone and here in the Netherlands?
Yeah, I think the state of play in the Eurozone is not entirely comparable to that of the US. We just came out of more than a full year of economic stagnation. Now, luckily, the signs of recovery are clearly there. We started off the new year much stronger than we had expected. And if you look at the soft indicators, that recovery is expected to continue into the second quarter, and it's even expected to accelerate in the second half of the year. And this is mainly on the back of ongoing recovery in real wages, ongoing recovery in purchasing power, and strong consumer demand. Now, there are two ways in which you can look at this recovery. Of course, you can say, on the one hand, the economy has proven to be resilient. We've went through quite a number of shocks, monetary tightening, unprecedented, and yet we did not really go into a recession. The sacrifice ratio of the disinflation process that we had to go through was virtually zero. Unemployment did not budge. So resilience was there. But on the other hand, the growth was clearly not as abundant as it was in the US. And that is clearly remarkable. Now, I think there is a multiplicity of factors behind this growth differential, but if you allow me to single out the two most important factors in my view. First of all, fiscal policy. And this was not only about the size of the fiscal stimulus, it was also about the design of the fiscal stimulus during the pandemic. In the US, there was a choice for temporary layoffs, income support, and then rehiring when the economy reopened again. Well, that means that a lot of labor reallocation took place, and we know that such reallocation is very productivity enhancing. But in Europe, we chose a different approach. We chose an approach that was focused on job security. The governments essentially took over the wage bills of the firms. And as a consequence, we froze the supply side of our economy for a couple of years. Then during this period of stagnation, there was a lot of labor hoarding, which means that we have gone through a number of years where there has been hardly any labor or, for that matter, capital reallocation. So we have not enjoyed these efficiency benefits of reallocation as much as the US. And secondly, the economic impact, the negative economic impact of Russia's unjustifiable invasion into Ukraine were, of course, also much stronger on this side of the Atlantic than in the US. We are a fossil fuel importing area, so it meant that this was a very strong negative terms of trade shock, and this terms of trade shock of which we are recovering still also today. Now, on inflation, I think the picture is that I'm increasingly confident that inflation will decline towards our 2% target during the remainder of the year. This is mainly on the back of goods and food price inflation that is coming down. Services inflation has been resilient for a while, but we're now also seeing the first signs of improvement there. And that has everything to do with a slow but gradual moderation of wage growth, which is quite essential, I think, also going forward in making an assessment of inflation risks. But all these developments clearly point toward further disinflation. Also here, an intriguing question is, of course, is there more similarity or are there more dissimilarities with the development in the US? From the onset of the inflation shock, it was clear that the balance of root causes between, let's say, positive demand shocks and negative supply shocks was different in Europe from the US. The US had a much stronger demand component. I think we had a much stronger supply component. Yet at the same time, there was a remarkable synchronicity if you look at the development of actual inflation. So the bump that you've been seeing in the US, the question for us now is, are we going to see such a bumpy development as well? So far, we've not seen any evidence of it, but that's clearly a warning signal for us, also not to come with any sort of premature declarations of victory. All in all, I do believe that inflation is probably less persistent in the euro area than in the US. And that leads me then to conclude that if we manage to continue on this track, if the incoming data continues to validate this development, that it will be appropriate for us to gradually take our foot off the brake, to remove some of the restriction, the monetary policy restriction that we're currently imposing on the economy. The data that needs to confirm this, a lot of that will be available at our June meeting. We will have an additional data point on the labor market coming out next week, the triangulation between wage growth, productivity growth, and profit margins, which is important. Then we will have new projections. And I'm confident, again, that if they confirm the picture, as I just sketched it, that June will be a good opportunity to make a first move in removing restriction.
Okay. Very clear hint at June there. We'll come back to whether we could see further moves in July too. But just to draw on some of your comments there, you seem broadly confident that inflation is going to prove less of a problem in the Eurozone than it seems to be at the US at present. And we've seen quite a reasonably high PPI reading today from the US, Chair Powell. Some people have said that looks hot. What do you think of today's reading? And more broadly, is there a risk that inflation becomes a lot more of a problem in the US than it is elsewhere?
So we had a producer price index reading just a couple of hours ago, and I would say it's actually quite mixed. The headline numbers were higher, but there were backward revisions, and we're of course disassembling it, taking it apart, and looking at it. And I think markets and analysts are looking at it as I wouldn't call it hot. I would call it sort of mixed. But in terms of the overall picture for inflation, I think you have to go back to last year, where we had historically fast disinflation. Inflation came down by two full percentage points last year. Why did that happen? It's really two forces working together. One of them is just the reversal, the unwinding of the pandemic-related supply and demand shocks. So that we thought we would always get that. We thought we'd get it in 2022, and we didn't, and then it really arrived in 2021. So that was a big part of this, was just the reversal of distortions really to both supply and demand. The second thing is just restrictive monetary policy, and restrictive monetary policy cools the economy and makes room for the supply side to heal, but also lowers demand and ultimately lowers inflation. So I do think those two have been working together. And the question you ask is inflation going to be more persistent going forward? I think, and that would essentially mean that we've gotten the supply side gains that we're going to get, and now it's down to lower demand, which would take longer and potentially be more painful. I don't think we know that yet. I think we need more than a quarter's worth of data to really make a judgment on that. We know that there are still, businesses still report that there are shortages and labor shortages and things like that, which are now being addressed. In addition, even when the shortage is alleviated, there should be lags before that shows up in economic activity and inflation. So there may be some more there. I don't want to give up on it yet at this point. I also think that having restrictive policy, we have the highest interest rates in some time. I think that it may be that takes longer than expected to do its work and bring inflation down. I am confident that we will do that, but that we will get inflation down to 2%, and ultimately we will do what we need to do with our policy rate.
And just to bring in a question that one of our members of the audience asked here, I mean, you referred to it briefly then, but from Edin at OAV, he asked, do you entertain the possibility that returning to the 2% target will not be possible with the current level of the Fed funds rate?
So I think, as I just mentioned, I do think it's really a question of keeping policy at the current rate for a longer time than had been thought. I think by many measures, the policy rate is restrictive. The question is it sufficiently restrictive? And I think that's going to be a question that time will have to tell. Entertain the possibility is that would be a very small probability, but I have said that I don't think that it's likely, based on the data that we have, that the next move that we make would be a rate hike. I think it's more likely that we'll be at a place where we hold the policy rate where it is.
And is there any particular component of inflation that concerns you? A lot of people in the US have been focusing on housing and that segment, but is there that, or is it something else that?
So we think of it in three buckets. The first of which is just goods inflation, and goods inflation was negative for 25 years, mildly negative because, of course, globalization and many goods were manufactured elsewhere and shipped at lower costs. So that, I think, is performing broadly as expected over time. We had very high goods inflation at the beginning of the pandemic because of the supply chain issues. That came down a lot, and I think we expect that. Housing inflation has been a bit of a puzzle because current rents have been low. Current rent increases have been low for some time, but they're not showing up. That's not showing up in rollover leases and in owner's equivalent rent. So, and I think what we've learned is that the lags between a decline in market rents and it showing up in the measured inflation for housing services is long. Their lags are longer than we thought. But as long as market rents don't go, as long as they're going up at very modest levels, it will show up. It's just a question of when. I think our estimate of the lags is there, and so you've got to look at that. That may affect your confidence, but we have to wait for it to happen. In terms of the biggest part of it is services inflation, non-housing services, and that's more than half of the index. And it's less interest sensitive. It's very sensitive to wages and that kind of thing. We had made some progress there, particularly if you look at the market-based aspects of it. But that's the one that I think may take the longest. At the same time, it doesn't need to go to 2%. It wasn't at 2% before the pandemic. You need the three of those to come out in some way that they're at 2%. And I'm confident that we will get there.
Excellent. And just to go back into this theme of divergence, I mean, to summarize your answer, it seems that, you think the geopolitical aspect of the Europe being closer to Russia, and also the aspect of not only the scale, but the design of the fiscal response, are the primary drivers of this divergence that we've seen between the US and Europe. Chair Powell, what would your thoughts be on this? Are there other factors that you think are worthy of consideration when trying to understand why the US and Europe seem quite different economic beasts at the moment?
So I agree with all of the factors Klaas laid out. I would add we're probably also benefiting from a sort of strictly accounting GDP standard from new workers coming in to a large extent. I think the issue really is, and this is an issue that that the European economic policymakers are very, very focused on right now, is over the longer run, Europe's productivity growth has been about half of the US. And so ultimately all you've got is hours worked, and that's largely a function of population, hours worked, and then output per hour. That's going to be your economic activity and growth. And so productivity is really the thing that can enable living standards to rise over time. And there are a lot of theories on why that might be. I think from an American perspective, I would tend to point to the more flexible labor market, and also a more fully built out set of capital markets, which is parts of which are very focused on funding early stage innovative companies. So it's not just a bank centric system. We've got a very highly evolved financial system. That may be another factor.
Yeah. So plenty of other reasons there that are worth mentioning, I think. Turning back to you, President Knut, you gave a pretty clear signal, I think, that we're going to see a move in June. But a lot of the questions that people have put to us today have, stressed this point of, usually there's been this sense that the ECB has been following the Fed, and it's raised a bit of a question mark as to what degree can the policies of, the two major global central banks, with apologies to the Bank of England, how much divergence can we really see? So to what extent do you feel constrained by what the US central bank does, and would you perhaps be reluctant to cut in July should the Fed want to stand pat and leave rates as they are for the foreseeable future?
Look, I think if you talk about monetary policy of big central banks like the Fed and the ECB, that monetary policy always takes place in a global context. I mean, our markets are interwoven to a large extent, etc. At the same time, we both have clear domestic mandates that look on an economy which may be 10, 50% open, but it means at least 85% closed economy. So much of our inflation is actually being triggered still by domestic factors. So what we simply need to do is construct our own inflation outlook for the euro area. And yes, Fed policy is, of course, one factor that has an impact. And if you think about international spillovers, the first things that comes to mind is through the exchange rate. If the Fed were to run a tighter ship than we were going forward, then probably that would lead to some dollar strength and euro depreciation, which of course leads to additional imported inflation. But at the same time, you will also have a spillover effect through global financial conditions. Bond yields internationally are also moving in tandem. If you look at the last few weeks and months, bond yields in the euro area have gone up significantly without there being a true euro area reason for doing that. It was just the spillover from the US. And that effect is, of course, disinflationary. So if you look at the two effects, it's not so clear which of the two will dominate. And it's therefore also not so clear whether the developments in the US will really have a meaningful impact on the inflation outlook in the euro area. I don't think it will change the direction of travel in the euro area that much.
So you'd be willing to cut in July too?
Well, we've been saying all along that we follow a data-dependent and a meeting-by-meeting approach. And I keep repeating here, it is essential what is happening in the labor market in particular, because services inflation is still the main remaining driver of inflation in the euro area. So we will simply have to follow the data as it comes in, both on underlying inflation trends, the labor market, etc. And that's why there is no commitment beyond June. We will just follow a meeting by meeting and a data-driven approach. And data, when it comes to the labor market, it's really about the comprehensive assessment of the labor market. It's too simple to just look at sort of contractual wages. Contractual wages are coming down, but one of the problems now is that we have negative productivity growth in the euro area. We had negative productivity growth in Q4. In Q1, again, it seems as if growth in employment exceeds growth in GDP, which means that probably next week we will get another negative productivity growth number. And that means that unit labor costs are actually still going up. And then the question whether profit margins are capable of continuing to absorb these unit labor costs, that's something that we really have to assess over time when we decide on future steps. So nothing, no commitment whatsoever, open mind for anything beyond June.
And just to turn back to the issue of US inflation for a moment, even though there's this sense that we did see a remarkable drop of inflation last year because it was, just so aggressive the year before that, that there is this sense that, there's still a public perception that prices are very high. How difficult is it to really feel as though you can keep credibility at times when trust in public institutions is under siege? And that's from Jerome Broekman, who's from Leaders in Finance.
So I think for central banks, credibility is kind of everything. And we only earn that one way, and that's by achieving our mandate for the benefit of the public over time. And also I would add, a part of that is sticking to our knitting. Don't take on politically fraught issues that are really not our mandate. Do your job and explain as best you can what's happening in the economy. Of course, the economy the post-pandemic economy has surprised everyone. I wouldn't single out any single central bank or group of forecasters. It's just been many things that were not supposed to be able to happen have happened. Nonetheless, we've made real progress on inflation. We're far lower than we were. I would say the risk that at the beginning we were very concerned that the very high inflation we saw might be quite difficult to bring down without a kind of very significant decline in employment and weakening economic activity. That didn't happen. That's just a great result. I think people are unhappy. You mentioned people are unhappy. That I fully appreciate that. And a big part of that, I think, is go to the store. Prices are high. You tell people inflation is coming down, and they think, I don't understand that. The price of all the things that I buy hasn't come down. So, they're not wrong. I mean, they're suffering. Particularly people at the lower end of the income spectrum are very hard hit by inflation from the start, which is why we're so strongly committed to restoring price stability and keeping it in place as long as possible.
And just to turn back to Europe now and to the Netherlands in particular, we're sitting in a venue here that's really testament to the power of trade, for good and ill, in an era of deglobalization when we're seeing daily headlines about tariffs. And how does the Netherlands as a small open economy, and indeed the Eurozone as a very trade-dependent region, really thrive?
I'm going to take a moment while he's talking about the Netherlands, just because we're going to be focused a little bit more here on the U.S. and the ECB and the Fed as a whole. Just wanted to kind of highlight where we're at with that. So Jerome Powell kind of reiterated arguably a little bit more dovishness, as he has been. And for newbies, new people, when I say dovishness, what I'm referring to is the willingness for the central bank to want to loosen monetary policy constraints. So cutting interest rates, making it easier for consumers, businesses, people to borrow money, and that is kind of stimulus in the system. So everybody you heard her ask the gentleman from the Netherlands about whether or not two rate cuts could be coming in the next few months for the ECB. Everybody's wondering the same thing. When are central banks going to cut interest rates? Jerome Powell was given the opportunity to talk on the producer price index here that we saw this morning, which was a measurement of inflation that tracks wholesale prices. They came in higher than expected, but Jerome Powell pointed out that they revised the previous number and that they look at that number as kind of a neutral whatever number. Again, he also mentioned that he still thinks that we can get inflation down to the 2% target. He also mentioned that he still thinks, to the best of their knowledge, that the next move from the Fed will be a rate cut, not a rate hike. So again, we see a pattern here emerging with Jerome Powell. And by the way, I will pull him back up. We'll have him back on the screen if he starts speaking in just a moment. We have a pattern here from Jerome Powell of wanting to cut rates. It seems from his jargon, from his narrative, it seems like he wants to cut rates. And again, this is what traders have to do. You have to read through the lines of what these guys are saying. Yes, we had a hot print. Also, I took a look just for fun. The gentleman from the Netherlands, he mentioned that what has contributed to European inflation has specifically been the services PMI. You can see there is a services PMI on our software. It's been a consistent kind of problematic inflationary metric there. But I do think that they spoke a lot specifically about the kind of relationship between the ECB and the US. And I think we might have Jerome Powell speaking. Not quite. I'm keeping an eye on it. Chandler, just throw it up on there if he starts speaking. But I can't tell. I think he is. Yeah. Okay.
To just have opinions on all different kinds of economic policies, as fun as that might be. The elected government has to deal with these things, and they have to deal with the public on them. And they've given us really important assignments, and I think we need to honor the decision not to give us that.
And I appreciate this is also an awkward topic, but it is deficits in the sense that the national debt is forecast to rise by the Congressional Budget Office quite substantially over the next 10 years. Does that make your life trickier as Fed chair rather too?
I don't think it's not that it makes my life more difficult or the Fed's work more difficult, but I think it's utterly non-controversial to say that U.S. fiscal policy is on an unsustainable path. Not that our fiscal position itself is unsustainable, but the path is unsustainable, meaning that we have full employment and we're running big structural deficits, and we're going to have to deal with this sooner or later, and sooner is a lot more attractive than later. I do hear from elected people on both sides of Capitol Hill and in both political parties that they do understand this. Mm-hmm. And I think you mentioned the Congressional Budget Office. I think everyone should be reading the things that they're publishing about the U.S. budget deficit and the path, and should be very concerned that this is something that elected people need to get their arms around sooner rather than later.
And you've noticed a lot, you've noted a lot that these supply side benefits that you thought might come in 2021 or 2022 did actually arrive in 2023. What sort of benefits from the supply side do you think we could see in 2024 and beyond?
So I think we probably have realized most of the reversal of the pandemic supply side effects, but not all of it. But I think we could get more sort of the final parts of the supply chains really getting sorted out. As I mentioned, the surveys of businesses, they still say there are shortages. They still say that they have a hard time hiring people, for that matter. So I do think we're still getting very substantial numbers of people coming to the country and going to work. Let me add, immigration also not a policy that the Fed works on or has opinions on, but I'm just giving you the straight economics of it. People come in, they can get a work permit, they are getting work permits, and they go to work and they're paying taxes and they're creating economic output, and there are millions of them. So it's alleviating the labor shortage that we had in the industries that really had it the worst. So I think all of that, it probably helped at the margin a little bit in cooling the labor market off. It's both supply and demand, but we think at the beginning, in the longer run, it should be neutral on inflation, but in the short run, it might have been positive. So I think that's a factor too.
And just to kind of tend to these broader demographic trends, there's been a lot of talk in recent years about how they will impact inflation, whether they have some sort of impact on R-star, the kind of, the Goldilocks level of interest rates in the longer term, one might say. I mean, how do you think about these kind of longer term demographic trends and other factors and how they're going to influence where you see this kind of magical Goldilocks neutral rate of interest?
So the R star, for those of you who aren't
Jerome Powell laughing. That's
who
a
read every
bicycle.
word of every story
kidding.
Claire writes about us. R star is really a longer run concept. R star is a neutral interest rate that would neither push up on economic activity nor bring it down at some hypothetical future time when we're at full employment, we're at 2% inflation, and there are no shocks hitting the economy. So think 5-6 years down the road, there's this sort of nirvana out there. Its relevance for current policy making is kind of limited, and I think you need to say that. But really what we're doing in an FOMC meeting is we're looking at the broad effect of the things that we're doing on the economy, and we're asking ourselves, is policy tight enough? Is it too tight? We're looking at what's happening in the economy. We're thinking about lags, and it's not a debate over the level of R star, because that's a longer run concept. Now, and the argument is made that R star will go up, and this is a debate that economists have been having for some years now. But the idea is, between deglobalization and the need to fund the energy transition, and perhaps the need to spend more on military, and the aging of the population, bigger deficits, higher, all of that could push up what is a neutral rate. And I think those are the interesting debates to have. But ultimately, we're not sitting around wondering what the longer run neutral rate is when we do policy. When we make policy, we're thinking today, is our policy delivering what the economy needs to move it toward the mandates that Congress has given us: stable prices, maximum employment.
So would you divorce it? I think why this has come into focus, if you like, is because now that rates cuts are being considered in some parts of the world. At least there's this sense in which people are thinking, how low will rates go? Would you see that as part of the kind of R star debate, or would you want to divorce the two factors of this current cycle and where R star will end up being?
I think the R star debate runs in the background, but again, it's a longer run concept. You could, if you wanted to think about a shorter run R star, that would be more relevant. But that's not the way we think about it. We think about the effect of the things we're doing on financial conditions more broadly and on the economy, and how is it affecting the economy, and why, and and all of those things lead us to believe at this time that policy is restrictive, and that it looks like it will take longer for us to become confident that inflation is coming down to 2% over time.
And how is this debate occurring around the table in Frankfurt at the ECB about longer run interest rates, or even, where are we going to end up? What's the rock bottom for this cycle?
Yeah, I mean, that's, of course, a difficult question to ask, because there are so many moving parts here. But what I would say is that if you look at the likelihood or the likely nature of the shocks that will hit us in the future, we came out of a period in which we had globalization, which was a slowly moving positive supply shock, ever more goods for ever lower prices coming from the rest of the world, which meant that for almost 10 years, we continuously had to approach our inflation target from below. We had a low inflation problem.
I'm going to take a quick second just to give you a little bit of an update as we go forward. Also, just curious, maybe we can do a poll in our YouTube here or Telegram, either one, Chandler, if you want to set up a poll for us. Do you guys like Jerome Powell, or do you dislike him? I think if you are a regular viewer, you know my perspective. I'll share it in just a moment. But once we have a poll, we'll respond to that. Stock market's flat on the day. What a crazy, ugly move back and forth. S&P was down on PPI, kind of bounced back as we saw revisions to the previous number. These are inflation numbers. Revisions were lower for the previous time around, and this latest one was higher than expected. So you kind of had this mixed bag. We heard Jerome Powell speak on that. Then the market jumped on Jerome Powell's sort of dovish tone, but Jerome Powell has made this point before and the market kind of freaked out, which was he's very vocal that longer term, like, our deficit is unsustainable. I don't think he even mentioned he doesn't think that's controversial. I would say that's pretty much a given. Here we are, we're in such a roaring economy, and yet at the same time, our debt grows every year. That's not usually the combination that you get if an economy is really roaring. You usually see debts, not necessarily just parabolically rising. That being said, if we get Jerome Powell speaking again, please take over the screen again, Chandler. I'm just gonna. Oh, she's here.
We've seen The labor market's a good place to see this. You've seen demand for workers cooling off pretty substantially. The ratio of vacancies to unemployed people, for example, has gone from more than 2 to 1 to now 1.3 to 1, and it was 1.2 before. So that's a decline in demand. That's demand related. You also see wages coming down. You see quits coming down. So I think that tells you that policy is probably restrictive. I think it's also fair to say, though, that the U.S. economy is different this time for a couple reasons. One is that people financed themselves into very low rate mortgages, and now they won't move because they would be moving into a higher rate mortgage if they did, and they would be throwing a lot of value away. The same is true of businesses, many of which, as indeed you would expect, have termed out their debt. And so they're not feeling the effects of interest rates. So it may be that policy is hitting the economy not quite as strongly as it would have if those two things were not the case. Notwithstanding that, I think the overall picture still is policy's working. It's weighing on spending. It's weighing on interest-sensitive spending, and it's weighing on the labor market. It's a question of restrictive policy. As I mentioned, our policy is the highest it's been in quite some time. The rate is, at 5.25% to 5.5% is high relative to recent history. So we think that it's probably a matter of just staying at that stance for longer, and that's how we're thinking about it.
And I mean, you note about housing and about the standard model in the US being I think I'm right, the 30-year mortgage is kind of the standard mortgage product. I think here in the Netherlands, flexible rates are quite more fixed rates.
Yes, absolutely.
So fixed rates are quite common too, but I imagine with shorter
10, 15,
duration.
An average mortgage, I think, has an average maturity of like 16 years. Of course, that's a little bit endogenous because of the low interest rate period we had for so long. That, of course.
Another opportunity for Jerome Powell to reiterate any sort of hawkishness. He denied it. What he just said right there, if you think about it, she just said, basically the question again, is the next move a rate cut or a rate hike? He said, next move still seems to be a rate cut, but we may need to hold for higher for longer. He also just mentioned, which I guess is actually positive for stocks, he thinks that monetary policy is restrictive enough until something changes. That would suggest, that it kind of supports his idea that we can just hold interest rates at where they're at. They don't need to go higher. Higher interest rates, again, how would that impact the market? Stocks would drop, gold would drop, the dollar would fly. But where it kind of seems like we keep finding ourselves is, they're just going to hold at the worst case right now with the eventual rate cut. That's why I think gold continues to look really attractive. I was asked, on my gold trade, I added a second time recently on GLD. So I added initially, my first trade was here. My second trade was yesterday around these areas. So I added a second position. I tracked it on XAU USD. This is the spot price of gold. So my first entry was here. Second entry was here. We'll see how this plays out. My stop loss is trailed. So if this market rolls over, so if I'm completely wrong and gold does not go up, I'll stop out and I will take profits on the first trade and a small loss on the second one. I am considering, if we do get a nice close today, trailing my stop loss further into profit. And again, how that would look on GLD would be, if we do get a nice close today, let's take a look at the hourly chart. I'd like to move my stop loss just below this low. So if price breaks that low, take me out. That's probably going to be how I close today, as long as gold stays supported. But again, economic data seems to be coming in cool. At the same time, inflation is sticky and not seemingly moving. But tomorrow we get the CPI report. I'll probably make up another decision tomorrow. So stay tuned. We'll be live streaming that tomorrow. Should be a big one. I think JP is speaking.
So that's part of the picture. I think the fact that we have capital markets are so important for many consumer loans of various kinds wind up in the capital markets or securitized and are not held by banks. It's just it's a very healthy credit machine for people, but they're feeling these higher. Those are short-term interest rates. I think that the ones that are longer-term interest rates are the ones where they're not feeling it, and that's really mortgages and that's companies that have turned out their debt. I think other forms of consumer debt are short term, and the surveys show that people think it's not a good time to buy durable goods like cars and washing machines, and the reason is it's a floating rate loan at a very high level.
Absolutely. And when you look at the banking system as a whole, we've seen some jitters, I think, on both sides of the Atlantic, but on the whole, it seems both systems are relatively stable despite quite substantial rises in interest rates. Has that surprised you at all? Maybe first to Chair Powell and then to President Knott.
Has it surprised? Not really. Our banks are particularly our large banks are strong, well capitalized, very successful competitively, globally. They're in I think one of the reasons why the recovery broadly around the world from the pandemic has been strong as opposed to the one from the global financial crisis is that the very large financial institutions came through just fine. The U.S. banking system overall is in good shape. Banks are making loans, as I mentioned. Credit conditions are a bit tight, but that's part of our policy. So I wouldn't say I'm surprised. I think we obviously had a period of turmoil early last year, and we acted pretty quickly to stem the turmoil and also to go to work as a supervisor and make sure that banks had good plans on liquidity, had capital, understood the portfolio losses that they have for longer run securities, and are in a position to understand and manage those.
Well, I think it's pretty clear that if you have such an unprecedented rise in interest rates in such a short period of time, that this constitutes a massive shock to the financial system. So when we were sort of in the process of tightening, of course, this was sort of enhanced monitoring, an area for enhanced monitoring. Now, I think we can say so far so good. I entirely agree with Chair Powell that the core of the financial system has held up quite well. And I think this is in part, I think the success of the financial reform agenda that was rolled out after the global financial crisis under the aegis of the Financial Stability Board, which was very much focused about stronger capital, stronger liquidity, stronger risk management at the banks, which were at the core of the financial system. And that has clearly paid off. Now, there have been some idiosyncratic accidents here, the second-tier US banking system, Credit Suisse, but I think there were idiosyncratic factors behind it. And the banks that arrived into trouble in the US were not even part of the Basel III arrangement and the financial reform agenda. But I would say so far so good. The question marks today are much more in the non-bank financial intermediation space, where we have seen a couple of quasi-near miss accidents, I would say. The Dash for Cash, the LDI, the Archegos, the commodity traders in February 22. So these have all been pockets of vulnerabilities where you saw a combination of excessive liquidity mismatches combined with pockets of hidden leverage that we were unaware of before. And that is now also front and center of the work program of the Financial Stability Board, much more the NBFI space. Of course, we have to learn the lessons from the few banking failures that we did see, and that is continuous maintenance. But I think if you were to ask me, my main focus is more on the NBFI space than on the banking space.
We'll come back to Credit Suisse because I know that's a topic that you've spoken about quite a bit, and a few of our audience have got questions on that. But non-banks, would you share that, that sense in which they're the big lurking danger in the financial system right now?
I guess I would say it this way. In the U.S., non-bank participants by non-banks in lending activities, for example, has been growing very, very fast. And it's a fairly new thing, and in many cases, whole markets are being now taken over, or now majority for non-banks. And so our job is to monitor that very carefully, because I'll say a couple of things. One, there hasn't been a downturn yet. You worry about very fast growth in anything. It just kind of raises financial stability questions, and you wonder, is it a bubble? What will happen, and will it deflate, and that kind of thing. And so you want to be watching it carefully. I will say, though, it's different. You know, some of the we've spent a lot of time looking at it. I just point to a couple of things. One is many of the lending structures are not subject to run in the way that banks have traditionally been. The funding tends to be from limited partners who have their investment locked up for many years, and they can't get it out. So as opposed to the danger with a bank can be that all the depositors want their money at the same time, and that's the traditional problem that we've been trying to solve with bank regulation for hundreds of years. But these are different. They don't have, and runs are responsible. Bank runs or things like that are really responsible for an awful lot of the problems that happen in one form or another. So the non-bank financial sector doesn't have that as much. Another thing is the ties between banks and the non-bank financial institutions are substantial and growing. So there's plenty of monitoring for us to do there. It's not obvious to me that at this point that it's a net loss to financial stability, but I would say our jobs are to monitor it very carefully and thoughtfully and understand the implications.
And just to return to the topic of Credit Suisse, we had a question submitted ahead of the event. In your keynote speech at the 7th Annual Conference on European Systemic Risk, you talked about events surrounding Credit Suisse. What can the Foreign Bankers Association, to which we're speaking today, and the Netherlands Bank learn about the collapse of the Swiss lender?
Well, I guess the main thing one can learn about the collapse of Credit Suisse is the huge importance of governance within financial institutions, because it is pretty clear that the events that led to the failure of Credit Suisse were not sort of a classic lack of capital or let's say too much credit risk relative to the capital. It was management failures, there was outright fraud, there were misinvestments, there was misbehavior even at the top of the institution. And if you have a series of governance failures at an institution, it will lead to an erosion of confidence. That erosion of confidence will lead to deposit runs, which, by the way, already took place much earlier than March 23. There was already a significant outflow of deposits also in the fall of 2022. And so we have to remind ourselves, it is not only about capital and liquidity. Governance of financial institutions is of utmost importance.
And are there any questions about AT1s and the treatments of those particular instruments that you think can be drawn in the Dutch context?
Yeah, of course, there was a case where AT1s have...
Real quick, guys, I just want to drop a quick plug. If you guys have not already joined our giveaway, we're giving away $1,000. Well, actually, we're giving away $6,000 total. But if you guys haven't joined the giveaway, it's free to join. We're going to drop the link here in the chat. I just see we're waiting this guy to finish up talking about the Netherlands. Nothing against our Netherlands friends, but just wanted to take this as a second to quickly drop that link. So Chandler or James, one of you guys could just drop that for us. Again, fill out this form. If you want to join the giveaway, it's free to join. Random chance to win $500. We're giving it away to 2 different people. I'll have updates on that soon. We've already announced 2 winners. So we've given away $1,000. So join if you have not already. It's free to join. We're going to drop the link here in just a moment, and we can go from there. Definitely, if you have not, again, reason we're doing that, there's a long story short. We had an influencer transparency challenge where if anybody, mentioned or showcased their track record, their trading performance over a long period of time on the trading influencer side, that we would donate or give away money to the community. No worries, Chandler. It's coming. Thank you very much, Adam, for the $279 Canadian. Trading as only income, how you survive a losing year. Adam, trading is not my only income. I do YouTube, I have a software business, and I trade as well. I also have a couple different trading styles and strategies. During 2022, I had a losing year on my momentum trading strategy, but on the FX side, currency trading, I did okay that year. It was just stocks that I did terrible on. Anyways, here's the giveaway link. Click this link, join for free, random chance. Again, thank you very much, Adam, for the $279 donation. I think Jerome Powell is speaking again, so we'll go back to JP.
Fairly quickly. or how long the economy would remain closed, or was it even going to be possible to reopen the economy if it had to be closed for a year? What was that going to look like? So I think it was so uncertain that I came to the view, and my colleagues did too, that we really needed to use our tools in ways that we hadn't before, because I would never have been, if things didn't work out, I didn't want to, if we had to go through a really deep, lengthy downturn, I would not want to have to explain why we didn't do that. So we did, and what happened is we announced these very aggressive, vigorous programs to support markets that we had never had to support before, the municipal market, corporate debt, these were red lines that we said we'd never cross. But the thing is, when we made the announcements, the markets healed themselves. So we made very, very few loans. We had something like 6 trillion in lending capacity. So the announcement effects of the things that we did, it really worked this time. So I think broadly speaking, that the initial response was very successful and involved ultimately very, very little in the way of actual lending, a lot of announcements. Then the story goes on, and you have the reopening and the inflation, and we're still living through that. I think we'll have to judge that from a greater distance.
Anything you'd do differently in retrospect?
There's nothing I would do differently in the initial response. I think we did very well, and I think that the world continues to benefit from the strong response that we took, and we really avoided an awful lot of a bad tail risk there that could well have come due. Again, I would say on inflation, when inflation kind of unexpectedly arose in the first quarter of 2021, I think we're going to need to, I've tried to resist reaching, conclusions about that episode until, it looks so different now than it looked a year ago, for example. All the progress we made in 2023, I think we're talking about it in a completely different way now. I think 2-3 years from now, we'll be doing the same. So I don't want to try to learn lessons, in the middle of the story.
Sure. Yeah, it's very fair. And another question here that's just been submitted from Abir, who asks, is Chairman Powell confident about the degree of independence of the Federal Reserve in relation to the executive branch of government? Do you think you have the powers that you need to defend your independence?
Yes, without question, I do. I think when I talk to elected representatives in both political parties in the House and the Senate, and I think there's very strong support on both sides of the aisle, on both sides of Capitol Hill, for an independent Fed. I think people do understand that we're just there to do our job on a non-political, non-partisan basis. Nobody's perfect. Everyone makes mistakes, but the Fed is doing the absolute best we can with the tools that we have and the understanding of the economy that we have. I think that is very broadly understood and supported on Capitol Hill. So I'm less worried about that than the sort of things that have been in the press lately might suggest.
Okay. The same question to you. Do you feel as though the ECB's independence is well enough enshrined?
Oh yes, I think the ECB has one of the strongest statutory independencies of maybe all central banks in the world. And I just, let's zoom out just for one moment. I mean, this inflation shock that we had, if you compare it to the previous inflation shock of the same magnitude, which was the 1970s, when we didn't have independent central banks, the main difference why I think now we have a credible prospect of getting the problem under control within, let's say, 3 or 4 years, while in the 1970s, it took 10, 12 years, and the disinflation was so much more painful. The sacrifice ratios were so much higher, higher unemployment, etc. The big difference is central bank credibility. During this huge inflation wave, inflation expectations continued to be well anchored. They never drifted away from 2%. This is so different to the 1970s. And why were inflation expectations so much better anchored this time around? Of course, that you can have a debate about it. It's about psychology, etc. But I would posit that the higher degree of central bank independence is clearly an integral part of that story. So this is a very tangible way in which we can show to society the benefits of having independent monetary policy making.
Would there be anything that you'd like to add to that on the case for central bank independence?
I think Klaus said it very well. I mean, and I think in the United States, we don't have quite the constitutional, I think, support that you have for it. It's a statutory arrangement. It's an institutional arrangement that has benefited the public. And that's all it is. Congress can change it anytime they want. It would take Congress to change it, though. There's nothing the executive can do. Again, I don't think that's likely, but as long as what we're doing is keeping our heads down, working on the things we're supposed to be working on, doing our absolute best, and explaining ourselves as best we can, acknowledging mistakes, and going forward, and that we will have the faith in our independence that we need, and I think we do have that now, and I'm determined that we'll continue to have it.
And I think that's a very suitable note to end this discussion on. I'd like to take this opportunity to thank the Foreign Bankers Association for putting on this wonderful event, the organizers Richard and Maxine, at Cognito Media, our audience here.
All right, guys, it seems like it was the majority of what was going to be said here today. Let's take a quick look in terms of the aftermath. I'm going to switch over on my trading view just so we can look at everything. So in the aftermath, we have the S&P 500 dipped on PMI. The producer price index inflation figures, and then shot back up and then kind of followed through to the upside with Jerome Powell's, I guess, reiteration of his dovish stance going forward. It seems pretty apparent to me that he still wants to cut rates, but they're waiting for more confidence in the data. We've heard that a million times, so there's nothing outstandingly new to that. But I think that, now we have a little bit more data behind us. Like, we have our first round of, inflation data came in mixed, while the other data points that we discussed earlier within, the Edge Finder, when we walked through like PMI data, GDP numbers, jobs data. If you weren't here for that segment, I highly recommend just rewinding. You can go through that yourself with us. But my overall point here is that we're seeing signs that the economy is cooling. Not that it was absolutely red hot, but it was pretty strong, considering we've had 500 basis points of interest rate hikes out of the United States, and the economy doesn't just immediately roll over, is pretty impressive. But Jerome Powell, he also mentioned something in there that I think is very worth mentioning. Perhaps now the U.S. economy is not as heavily swung by interest rates as it may have been in the past. A lot of the economy is services based. A lot of the big companies don't rely on debt like they perhaps used to. Like, you can look at companies like Microsoft or Meta. These are companies that they don't need to borrow a ton of money, and they make up a huge portion of the economy, relatively speaking. So a lot of the, the big tech names are not so debt sensitive. Also, he mentioned that here's the frustrating part for those of you guys who want to buy a house someday. The frustrating part is that people who have houses and who have held on to them are holding on to also with that house some very sweet deals in terms of interest rates. That they have to pay their mortgage is much more affordable than what would, a new home buyer would need to pay in today's modern era. You can thank, for example, on that front, the rise in the, interest rates trying to slow down the economy. Take a look at here's, yields on a weekly basis over the longer term. We've seen them rise dramatically with the Fed's raising of the federal funds rate. And, you take a look at all that. You say the economy's staying strong. Yields are still very high. But Jerome Powell also made mention that he doesn't think that the next move will be a rate hike. In fact, he mentioned that he thinks the next move will probably be staying where we're at and eventually cutting interest rates, which would likely lead to that happening in the 2-year government bond. You could take a look at the 10-year if you want to look at that as well. But yields elevated, but he mentioned, the overall forecast is for a rate cut in the future. Where does that leave me in terms of perspective? I think stocks can continue to push higher. As crazy as it might sound, they've made such a big move, but you're looking at a stock market that's seen a really good earnings season. Relatively speaking, most companies beat. Tech earnings were pretty dang solid. The last one to fall, the last domino, I think, is the NVIDIA earnings, which come out May 22nd after the bell. So that'll be a big one for the market. But overall, it seems like, this market doesn't have an adversarial Federal Reserve, right? Jerome Powell doesn't seem like keen on rate hiking. And so the market can kind of celebrate that. Earnings have been pretty good. To me, the stock market is not my favorite spot. Again, as I mentioned earlier, I continue to be long gold as kind of a very soft hedge to slowing economic data, because here's the downside to the stock market. If the economy slowdown that we're seeing is not necessarily a slowdown, but full-blown potential recession formation, if that's the story, suddenly you have a very different picture where you have, the economy slowing, earnings could start to hurt, and that could bring the stock market down. So for me right now, I'm kind of neutral stocks. I'm bullish gold, as I do have positions I mentioned earlier. We're floating some trades on that. I'll go ahead and just show you the portfolio here, where we're at in terms of current positions. So let me go to positions here. I have some S&P 500 with covered calls sold on them. I have XLK. This is a technology ETF. I'm long tech with calls sold against it, as well as a bit of just a little slight hedge. I'm long gold, as I mentioned. Semiconductors, I've sold puts on that. That's looking pretty decent. Okay there. TAN, this is a solar technology ETF, which has done pretty well. Looks like I might get called away from my shares, which I actually wouldn't mind at all. But again, that's a 44 strike price. So we still got a ways to wait. If TAN continues to go up, then awesome. It's a small position in the portfolio, but it is a position nonetheless. Take a look at Bitcoin. I have a small short position on Bitcoin, which is a whopping $66 in profit. TLT, this is bonds. I'm long on bonds. Again, I think that rate cuts are probably coming at some point this year. Could be maybe one rate cut this year towards the end. That's where I feel like I'm at. But again, that would be positive for bond prices if yields started to fall. And I've also sold calls against it in the meantime. So I'm collecting some premium against my position. In terms of the S&P 500, as I mentioned, you do have a positive day for S&P. We'll see if that can hold. And the big data point for the rest of this week is going to be CPI and retail sales, which will show us a little bit of an insight into the consumer. So really action-packed week. If you enjoyed this stream, if this was helpful to you in any way, shape, or form, I hope this stream was, did something for you. If you could do me a big favor, hit the thumbs up button on the show. Thank you, everybody, for hanging out. Hold on, I got to turn on my sound here so you can hear my claps. There it is. Claps to you guys for hanging out with me. Thank you very much for sticking around. Hopefully that was helpful to you. Again, last call on that giveaway, by the way. We dropped the link moments ago, but if you would like to enter the $1,000 giveaway that we are doing, it is free to join. Here's the link. Fill out that form. Best of luck to you. And guys, have a great rest of your day. Trade safe. See you tomorrow for the big one.
Thanks again for watching today's show. Our goal at A1 Trading is to share free value to you, our audience, through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more, lest ye walk the plank. Join our crew as we head out to go long on gold. See you next time.